Okay, good morning, everybody. Okay, so today, sadly, our last day, so we have to get as much as we can get done today. So I'll do climate with you in the morning, and then Daryl will come do IFRS 9 with you in the afternoon. So obviously IFRS 9, very important. You're changing to IFRS 9, very different from IAS 39. So very important session this afternoon. Something that is important just because the world has changed recently, and climate has become very important to investors, is to talk a little bit about climate issues in financial statements. So that's the session that I'm going to be taking you through. So we're still looking at the same version of IFRS. So IFRS is issued by the IASB 1 January 2024. So we just want to think a little bit about how climate risks are coming through in IFRS financial statements, okay, and then some of the judgments that are related to climate. So we'll go through the few case studies and things that I have set out here during the course of the morning. So if you read all of IFRS and you search for the word climate, it's not in IFRS. So IFRS says nothing explicit about climate. That doesn't mean you're not reporting climate when you do IFRS. Okay, so this is the tricky thing. People are saying climate is new, everybody's worried about climate, so where in IFRS does it say climate? Well, nowhere it says climate in IFRS, so we don't have to do anything about climate. Not true. Okay, so that's what we're going to go through now. Okay, so you can see here the UK FRC, the regulator in the UK, is saying we look for climate in financial statement disclosures, and we see a lot of variation in what companies are doing, and we're not sure that that variation is justified. So there's mixed practice, and maybe there shouldn't be such mixed practice. So they wrote in one cycle to 16 companies to say, you know, give us more information about the climate effects in your business. And then they highlighted areas where they thought businesses could improve in their disclosures about climate. So we do expect for those industries that are affected by climate that we will hear about climate when we read their financial statements. So the fact that IFRS does not explicitly talk about climate does not mean that you won't have climate in your financial statements. Okay, so that's just to think about why that is the case. The regulators and the IASB, for that matter, are citing these overarching disclosures. So once you've prepared your financial statements, you're supposed to take a step back and look at them and say, is there anything else I need to disclose so that people can understand my financial position and my financial performance? And one of the things that is being cited that should fall into that category is climate-related matters. Okay, so climate, we all see Spain had a year's rain in one day the other day. So you can see when those kind of things start happening, you have big floods, there are big droughts in other parts of the world, there's fires, there's all sorts of problems from climate. Okay, so we are expecting in financial statements that we will see where you are exposed to climate risk, disclosures about how you're dealing with that climate risk. Okay, so we'll go through some of the things that are happening to make that clearer to people. And then we discussed on the first day those disclosures from paragraph 122 and 125 of IAS 1. So sometimes climate is involving some of the biggest judgments and estimates that are made in preparing financial statements. Okay, and then we would expect those disclosures where climate is very sensitive to a particular organization. Okay, so there's a number of overarching disclosures that could trigger climate. Okay, it could be even a going concern issue for some industries. Okay, so for some industries, we'd expect to see something perhaps even in going concern. Okay, so what the IASB's done, and this is coming from something that the IASB done as education material, they said, well, for non-financial items, The places we expect you might see climate effects are, for example, when you are looking at the liability side, do you have any obligations with regard to climate commitments that you have made? So IAS 37, do I have a liability in that space? If I have a liability, does it meet the recognition criteria? And if it meets the recognition criteria, then how have I measured it for including it in my financial statements? And if it hasn't met the recognition criteria, you're still supposed to quantify for the contingent liability disclosure. Okay, so we're expecting to see more disclosures in contingent liabilities and in provisions themselves, but we'll go through the rules on that, okay, to show when you would have a provision and when you wouldn't have a provision, okay, because we don't want people recognizing provisions when they don't have a liability. You only should recognize the provision when you do have a liability. And that recently has been to the Interpretations Committee. And I think the Interpretations Committee was getting hit on the head by people with a big stick that, you know, the climate activists wanting more climate provisions when they don't meet the definition of a liability yet. Okay, so they stood quite firm and said, no, if there's no liability, you can't yet create the provision. There might be overarching disclosures, there might be other things, but you don't yet have a provision. So it's important to be able to draw the line for where you do have a provision and where you don't yet have a provision. So we will look at what was done in that space in a minute. Okay, and then also, because of climate change, for example, if you're in the airline industry, okay, you might be retiring more fuel burning planes earlier than you otherwise would have. So if you look at BA, British Airways, for example, they retired all of their 747s. So 747s were a big part of their fleet of airplanes, but they were great airplanes for when we didn't worry about climate change. But now that we worry about climate change, these planes aren't very climate friendly. So they retired all of their 747s earlier than had been expected. Okay, so they didn't wait for where they were expecting their replacement would happen. They just retired them all early and replaced them with more fuel-efficient airplanes. So if you think about depreciation estimates, for example, the useful life obviously changed. Okay, so those are estimates all the time, okay, and we do expect that they will change over time. The depreciation method could change, the residual value could change. Okay, so all those estimates that go into depreciation could be changing. Okay, and then of course there could be impairment testing because if people are going to retire these planes earlier and replace them, the second-hand value of them is likely to go down. And if the second-hand value is going down, okay, and you're going to retire them earlier, you maybe not going to get as much benefit as you thought you were, and there might be a need to impair them. That doesn't mean to say they will be impaired. It just means you will need to test them for impairment, that's all. Okay, so we need to think about it when we are thinking about impairment testing. Okay, and then when you're measuring fair value, so how are market participants thinking about climate as inputs to affecting the value of things? So, it's the market participant view. So if market views are changing, then the value of assets that are climate affected will change. Okay, so when you're measuring the fair value of something, you have to consider whether climate is relevant to affecting that fair value or not. Obviously, if it trades in a market, you don't have to think, you just look at the price in the market. But if you're doing, say, a level 3 fair value measurement, then you do need to think about what is affecting the fair value from the market participant perspective of that item. Okay, and then onerous contracts. So, you might have contracts that become onerous because of climate-related things, or at least affected in some way because of climate-related things. So particularly long-dated contracts, one needs to think about whether they are becoming onerous. Okay. And then the one the ISB didn't mention, quite surprised me, was emission trading schemes, okay, because I think they have been bruised so badly over the accounting for emission trading schemes that they just didn't want to talk about them when they wrote this education material. Okay, but obviously emission trading schemes are related to climate. Okay, and we'll go through the accounting for emission trading schemes in a minute, and it's a bit of a mess. Okay, and we'll explain why and then understand what's currently available in the market for people to do this accounting. Okay, and then if you're doing financial instruments, so we've looked at non-financial items, now looking at financial instruments, financial items. Okay, so classification and measurement can be affected by climate-related issues. Okay, so if you're the lender, okay, it's you know, when you're doing your SPPI test, you need to think about it. Okay, and when you are doing your as a borrower, whether you're going to bifurcate an instrument, you need to think about it. It might be affected by climate. There might be a climate derivative that you need to separate out. Okay, and then obviously with impairment of financial assets, okay, climate might be relevant to the impairment of financial assets. So in your IFRS 9 modeling that Daryl will do with you later today, if climate is relevant to those types of assets, okay, then you have to take account of it in your expected credit loss modeling. Okay, so it may or may not be for some of your debtors, okay, but you need to think about, or some of your instruments that you hold as assets, but you do need to think about it. Okay, and then disclosures, okay, you need to make disclosures under IFRS 7. Are you using IFRS 7 yet? Okay, so you are using it already. I know your banks are and your insurance companies probably are, but the other companies, are they using IFRS 7? Okay, if they're not, then you'll be stepping up to it soon. So IFRS 7 is all the financial instrument disclosures. Okay, so those risk disclosures, we'll look at an example just now. Okay, particularly where it affects measuring expected credit losses under IFRS 9. Okay, and concentrations of credit risk. So some of those concentrations might be climate related. So for example, if the collateral for housing loans and the housing loans are built in a floodplain, you're going to have a concentration of credit risk around those collaterals. Okay, so these are some of the things that you're thinking about. Okay, and the insurance contracts, okay, so you're acutely aware of climate problems if you are in the insurance industry. Okay, because if you in Spain this month, you are paying out as an insurance company huge amounts of money because of climate change. Okay, so you're having a year's rainfall falling in one day, suddenly people are dying, properties getting damaged, everything's getting damaged. Okay, obviously in the insurance industry, it's going to cost you a lot of money when that happens. Okay, so insurers, I think, are probably more acutely aware of the risks than most other businesses. Okay, and then there's something else that I think is very important that has happened recently. So, recently a lot of attention is being paid to what is called connectivity. So where people write stories like they do a climate report or a sustainability report or some kind of MD&A that they do outside their financial statements, and they like to say lots about sustainability issues, like I put pot plants on every windowsill, all the greenwashing stuff that you see written. Okay, so now going forward, if you are using IFRS sustainability standards, okay, which I'm sure aren't being used yet, but might be under consideration, or some other sustainability reporting framework, like in the UK, TCFD was being used, which came from the Financial Stability Board. So it was very common in the financial industries, but also used in the non-financial industries. So there now needs to be connectivity between the disclosures outside your financial statements and the information in your financial statements. So I think this is a big step up in the information that's available to people to use to make investing and lending decisions. And you know, some of this information has existed before, but hasn't had to be connected. So the story you told outside your financial statements could be totally disconnected to the story you tell in your financial statements. Now we have to connect those two things. So if something is written in your sustainability reports that as a reader, I would think, okay, so this is probably affecting the financial statements here and here, but maybe in your financial statements, because you use the cost model, there's no effect. Okay, then you need to explain why there's no effect. Okay, so that's what connectivity is. It's not just about where there is the connection. It's also about explaining where the reader reasonably expects a connection, but there is no connection. There's a disconnect. So explaining disconnects. Okay, and the investors are very happy to be receiving this information. They have for too long read with great skepticism the sustainability reports that companies produce because they're not audited, they're not connected. So it's advertising is one way of thinking about it. Okay, and then in the financial statements, it's audited, it's under a more robust framework. Okay, so you can place more reliance on it. Okay, now that connectivity is going to bridge the gap, basically. Okay, so I think it's super important that this has happened. And I'm quite excited about it. Okay, so what is in the IFRS world? And you know, in North Macedonia, you need not adopt IFRS sustainability standards. I think you haven't yet decided what you're going to do in the sustainability space, if I'm correct. Okay, and you probably kind of on the EU path, so you're probably thinking more of I don't know what you're doing, but I suspect you might be thinking more of the ESRS, the European Sustainability Reporting Standards. Okay, but they also have this connectivity. They just go a lot wider than IFRS goes. So IFRS is just focused on investors and lenders. So we're only interested in financial materiality. We're interested in things that would be useful to investors and lenders to forecast your future cash flows. Okay, where ESRS takes a different approach. ESRS says, we don't really care if your investors are interested in this. We're interested, in addition to that, if you are having an effect on the environment, then you must make those disclosures. So the reporting under ESRS is wider than the reporting under IFRS sustainability disclosures. So we use the same materiality in IFRS for sustainability and for financial statements, where in the European Union, your consolidated financial statements are using financial materiality, because it's IFRS, but your sustainability reporting is going to use double materiality. So your sustainability report in the European Union is more a report to society than it is a report to investors and lenders. Okay, so drawing that distinction is actually quite a difficult thing to do. And some countries like South Africa have been doing what the European Union now requires for quite a long time. And they're thinking about, so now if we do require IFRS sustainability reporting, in addition to the ESRS, or they use GRI, which is like ESRS, then we have to somehow draw the line between, you know, what is financially material and what is not financially material. Okay, and that's sometimes quite a difficult thing to do. So the world is just in the process of working out how to do that. Okay, so some of this is quite new. And I'll look at IAG, which is a European company. It's a Spanish headquartered company, IAG. It's British Airways, Iberian Airways, the Irish airline, Aer Lingus, and a low-cost airline or two all together in one company. But this is the report we look at is before ESRS. Okay, so they're just using all sorts of different things, a bit of GRI, a bit of SASB, you know, a bit of this, a bit of that. It's the fruit salad of old, basically. So right now in the world, okay, we're going away from that fruit salad towards more robust sustainability reporting frameworks. Okay, and jurisdictions are in the process of deciding what sustainability reporting framework they want to use. And as far as I know, in North Macedonia, you haven't made decisions yet, but I could be wrong. Okay, so that's you know, a little bit of background to what we have here. But even if there was no sustainability reporting, you would still expect climate reporting in respect of all these things we have here. These things don't only happen because you have sustainability reporting. These things happen independently of sustainability reporting, just because climate effects are becoming material, not to all financial statements, okay, but to many sets of financial statements. So you don't need climate reporting for these things to be in your IFRS financial statements. Okay, so what is the IASB project with regard to the uncertainties like climate-related uncertainties? But they didn't want to look at climate only. So they said, okay, people are asking us for more guidance on climate, but we're going to do it in the context of all long-term uncertainties, including climate. So they published an exposure draft, which is out for public comment at the moment. So you have until the 28th of November to comment on the exposure draft if you want. So an exposure draft is typically a proposed standard, but in this case, it is not a proposed standard. So all they've done is they've said, we think the IFRS requirements are already sufficient for you to do climate reporting in your financial statements. All those things we looked at on the earlier slide are already there. All they're doing in this exposure draft is they're saying, we're going to add some illustrative examples that accompany but do not form part of IFRS. Okay, so if you look at IFRS, the books published by the IASB, they usually have the standard, the requirement, but accompanying that requirement, they often have illustrative examples or implementation guidance that does not form part of the standard. Okay, so many countries, and I don't know how North Macedonia does this, but many countries that translate don't translate that accompanying guidance. And in the UK, the board I sit on that endorses IFRS for use in the UK, we endorse the requirements. We don't endorse illustrative examples and things that aren't requirements because we can't make them part of our law. Okay, so this is outside of the formal requirements of IFRS. Typically, when these illustrative examples are made, is when the IASB is issuing a new standard. And my understanding is that these illustrative examples are usually, they just help you. It's like illustrating a storybook with pictures, basically. It's just there to make it clear, you know, easier to access an understanding of something that is already clear in a standard. Okay, so it's not adding any new requirement. They're just illustrating, drawing pictures, if you like, okay, of the requirements that already exist. And remember, those requirements exist in the context of climate not being mentioned once in the standards. Okay, it's just there are risks that relate to climate, and those risks basically are the things that are driving these examples. So our board actually in the UK very unusually said we were going to do a public consultation on this, even though we don't endorse it. Okay, so we've discussed this in public meetings and, you know, said what we think about these examples, basically, which is a bit unusual because we won't endorse them. Okay, and not endorsing them doesn't mean we're rejecting them. It just means, well, they're not part of the formal requirements, so there's nothing for us to endorse. Yeah. Then the IASB has also sent a few things to the interpretations committee, okay, to say, you look at this and give an interpretation. So in particular, the one that they've dealt with already deals with whether or when a provision arises in respect of climate commitments that you make. So yeah, I promise net zero by 2050. Okay, do I have a liability if I promise net zero by 2050? Do I have to do anything between now and 2049? Nothing. It's just words. It's just nothing. It's the same as saying nothing to say, I promise net zero by 2050. Okay, it's just nice words. Okay, that's all it is. Okay. Okay, so in accounting terms, you have no liability from saying I'll be net zero by 2050. Okay, it's just, you know, I'm with the new thinking. It's kind of that's it. Okay, there's nothing, it means nothing. Okay. Okay, they've also said that they are going to expand practice statement 2. So practice statement 2 was some education material essentially about how to do financial materiality or materiality in IFRS financial statements. So they've said we're going to expand that to cover climate-related issues too. Okay, so that's a good idea. Expand the education material, okay, so that people can understand better how to apply materiality to climate-related issues. Okay. And then the last one, I don't know that they're going to take up, but they have thought of doing this. Those paragraph 125 disclosures of IAS 1 that we were discussing on the first day and the second day and the third day and now today, those you make disclosures when there is, you know, a reasonable expectation there will be a financial effect, a change within the next 12 months. And what some of the people are saying in the climate context is the change might not be as soon as the next 12 months. So therefore, they're not making the disclosures on the climate-related issues with, you know, under paragraph 125 of IAS 1. Okay, so the thinking is maybe it shouldn't be, we should take the 12-month limitation out. Okay, and it should just be, you know, in the foreseeable future, if there's going to be a significant change, then we should be making those disclosures. So whether or not that'll happen has not yet been discussed that I'm aware of. So it may or may not happen. That change may or may not come. But what it'll do, it'll make the paragraph 125 disclosures, like the sensitivity analysis with key variables, reasonable possible change in all those variables, it'll make those disclosures a lot more extensive. Because a lot of the time, the way preparers get out of making those disclosures is they say, but the financial effects, the change won't happen in the next 12 months, therefore I don't have to make this disclosure. Okay, so with climate, if it's a longer period over which you expect that change to happen, then it's not going to trigger the paragraph 125 disclosures. Okay, so that may or may not change. So currently the 12-month limit remains in place. Okay, that limit is only relevant to paragraph 125 to 129. Okay, it doesn't mean any of these other disclosures shouldn't be made. All the other overarching disclosures do not have the 12-month limit on them. Okay, so it's just that particular disclosure that does. Okay, so there are a couple of other things that are going to the Interpretations Committee with regard to climate, including impairment of assets. When IFRS 18, which Daryl discussed with you on the first day, was issued, they now talk about considering climate when you aggregate and disaggregate things. So climate could be the characteristic that causes you not to aggregate things that have different climate risk together. So in the past, we didn't really think about climate risk when we were aggregating, or we didn't explicitly think about it. Okay, but now you are explicitly required to think about that in aggregation. Okay, so, you know, a lot of loans in some jurisdictions like the UK, the government says to the banks, you know, when you're issuing loans, you should be putting a requirement in the loan agreement that if the company has said they're going to reduce their emissions by so much by a particular date, okay, so then if you're lending money to them and they haven't met that target, there's a step up in the interest rate. Okay, so you know, does this trigger the, does this make you fail the SPPI test? Okay, so the feeling was many instruments that were being issued were failing the SPPI test because of this, but there was inconsistent practice. Some of the bigger firms were saying it's not failing. Some of the bigger firms were saying it was failing. Okay, it was failing. Okay, or many of them were failing. So now the banks cry and they write to the ISB and say, but like every other exception there is when Daryl does the SPPI test with you today, can we please have an exception for this too? So we will still pass the SPPI test when these types of criteria are built into the lending instrument. Okay, so there's a cry to have another exception in the SPPI test. And there are already lots of exceptions. So this would just be another exception. So whenever somebody ends up with a situation where they have to account for an instrument at fair value and they don't want to do fair value accounting, they ask the IASB for an exception. Okay, and there's lots of exceptions. Okay, so this is just another exception that's, if it hasn't come already, I'm sure it'll come. Then another interesting one is power purchase agreements. So I'm a company that says to get to net zero, what I'm going to do is buy solar power or hydro-powered electricity. So I enter into a contract with a hydro energy company to provide me with hydropower, which is clean energy. Okay. But the trouble is that energy gets delivered to me through the national grid. Okay, I'm not getting hydroelectricity when I buy hydroelectricity. I'm just getting electricity out of the national grid. And then also, okay, if I'm locked into a supply contract, okay, there might be some electricity that I'm going to, under the contract, get delivered to me, but I don't need, so I'm selling it back to the grid. Okay, so I'm going to fail the rules for not accounting for the executory contract. So my executory contract's going to get kicked into fair value accounting and IFRS 9. Okay, and people don't like that answer. Why? I don't know. So to me, it seems that's where it should be. Okay, but they don't like the answer. So they're crying to the ISB and hitting them on the head with a stick saying, we need an exception from this. Okay, so I think already not accounting for an executory contract is an exception from the economics. Now they want an exception from the exception not to account for an executory contract. Okay, so it's just horrible. Okay, but they're winning this argument. Okay, in the UK, we kicked up a fuss about this. We said we don't think people should get exceptions from exceptions. They should just account for these contracts at fair value. Okay, but we are a small voice in a big world, shall we say. Okay, so I don't think anybody's, they'll say, yes, we hear you, but, we're going to do it anyway. Okay, so I think that's what's likely to happen. So that's going through the process now. And the indications are that a new exception from the exception will be provided, okay, and people won't have to account for derivatives as derivatives. They can account for them instead as not accounting for them at all. Okay, so that's kind of where we headed, I think, on that one. Okay. Okay, and then they sometimes just write some education type articles on connectivity, so just explaining to people better how that needs to be done. And then they say, well, maybe it would help if they improved access to their education materials so that people could read and understand better what they need to do in this space. Okay, so you can see there's some very specific small amendments that people are seeking to particular standards, okay, because of climate-related issues that have resulted in new types of transactions that, for example, will now fail the SPPI test or fail the executory contract test. And they're looking for exceptions to carry on doing the bad accounting, which is often not accounting at all for the thing that they were doing before. Okay, and they will win some of those arguments. We'll try fight it, but I'm sure they will win some of those arguments. Okay, so you can expect some ongoing change as climate becomes more acute, and it seems to be becoming more acute very quickly. Okay, initially people are going to fight accounting for it until they work out, well, we should have been accounting for this all along because it's so important. Okay, so That's just where we are. So something that has existed for quite a long time, particularly in the European Union, okay, is emission trading schemes. Okay, it's not the only place. So the UK was part of the EU when this happened. So when we left the EU, we have our own emission trading scheme. So it's just almost the same. In the US, there are quite a few voluntary schemes, emission trading schemes. Okay, there's some, we'll look at a few of them anyway. Okay, so the best example in the world is probably the EU emission trading scheme. So basically the idea is the EU wants everybody in the EU to reduce pollution, but it's an expensive thing for some people to do, and it's a cheap thing for other people to do. So it makes economic sense, okay, to say, let's set up a market mechanism that will make it as cheap as possible for pollution to come down in the EU. And whoever designed that is very clever, I think. I mean, it's a good solution to a difficult problem. Okay. So with the EU emission trading scheme, if you were polluting, say, 1,000 tons last year, you'll get a license to pollute 900 tons. And if everybody gets a license to pollute 900 tons that was polluting 1,000 tons, then pollution's going to come down 10%, isn't it? Okay, but then you can trade in those certificates. So if it's cheap for you to reduce your pollution, but expensive for me to reduce my pollution, then maybe you reduce, instead of producing 1,000 tons, next year you produce 800 tons and sell to me 100 tons of certificates. So I can carry on producing 1,000 tons, okay, by buying your certificates, and overall pollution is still coming down by 10%. Okay, so it makes sense because there's a cost to these things, and we live in a competitive world. So if we have costs that other people don't have, okay, then it makes us less competitive, doesn't it? So we don't want to hamper our competitiveness too much. But we want to get the pollution down. So an efficient way of doing that is let the market price it, basically. Okay, so it's a very sensible scheme to come up with to get this done. Okay, so once you've polluted, then at the end of a period, you add up your pollution and you have to hand back certificates. Okay, so different people, different companies deal with this differently. There was a Portuguese paper manufacturer that I spoke to. They got their certificates, they handed them to their treasury team and said, do with these whatever you want. Okay, but be aware, we're going to pollute so much and we have to hand in so many certificates at that time. Okay, so other companies see it differently. Okay, they hold on to the certificates they've got in order to deliver those very certificates to meet their pollution. So different people think of this slightly differently. Okay, so then what happened is IFRIC was asked to write an interpretation of how to account for these certificates and so on. And the problem that you have in IFRS is you've got three standards interacting to deal with this particular issue. So you've got IAS 38, the intangible asset standard, which is dealing with the certificate that you receive, because that's an intangible asset. And you've got IAS 20, the government grant standard, dealing with the fact the government gave you that certificate. Okay, and you've got IAS 37, once you have polluted, you have a liability to settle for the pollution. So you've got three standards interacting. And unfortunately, IAS 20 is do what you want accounting, basically. Okay, so IAS 20 is a very loose standard. Okay, it just says basically you must recognize in income the government grant that you get to match the expense that you are being compensated for. So all it's saying is work out what you're getting compensated for. When that thing becomes an expense, then you recognize the income from the gift that the government gave you. And the trouble is, different people see different things that you're being compensated for. So you can choose to visualize what you're getting compensated for to give you whatever accounting you want. And on top of that, you get two alternatives within the emission the government grant standard. The one is you can just record the certificate at nil, nominal amount, like 1 pence or 1 cent, okay? Or you can record it at fair value. Okay, so there's just endless difference in what you can do under that standard. It is rubbish, 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 rubbish. That's what it is. Okay, but the world doesn't seem to be fighting to have that standard replaced. I tried when the ISB did the last agenda consultation to say this standard needs replacing. Okay, but investors aren't calling for it to be replaced for reasons I don't understand. Okay, so we have the standard, so we have to deal with what we've got. Okay, and then you're all aware IAS 38 has 2 models, the cost model and the revaluation model. You can only use the revaluation model, though, under IAS 38 if you can measure fair value with reference to an active market. Okay, so if it's the EU emission trading scheme, those certificates trade in an active market, so you could use the revaluation model. Okay, but if it's one of those schemes where a voluntary scheme where they don't trade in the market, then arguably you couldn't use the revaluation model. Okay, so the IFRIC, I think, overstepped its own boundaries a little bit when it wrote IFRIC 3, okay, because it said, you know, you can't use some of the alternatives in the government grant standard. You must record them at fair value. And it said, and then in terms of IAS 38, it said you must use, in effect, the revaluation model, but put the change in profit or loss, if I remember correctly. So it's been withdrawn anyway. It doesn't exist anymore because the European Union said they didn't like the interpretation. So the IASB withdrew the interpretation. Okay, so now we've gone back to not having an interpretation of how to deal with this emission trading scheme. Okay, so, you know, since then, the ISB has tried a few times to start a research project on, well, let's think about this again and see what we can come up with. But they start and then they stop and they start and then they stop. So it hasn't gone anywhere yet. Okay, so in the meantime, companies have to account for emission trading schemes. Okay, and some years back, PwC, together with some other research organization, I think it was, wrote an article. So they did some research to inform this article. And they said about 5% of the companies they looked at are using the IFRIC 3 approach. So about 5% of the companies are doing what the IFRIC thought you should be doing. That's not a lot. Okay. 15% of the others are putting granted allowances initially at fair value. So EasyJet, for example, puts the certificates that are issued when it receives the gift of the certificate, it records it at fair value. Okay, so some Air France doesn't do that. British Airways doesn't do that. Okay, so different airlines even are doing different things. Okay. Okay, and then another 5% are just recording the granted allowances nil, but the obligation, once they have polluted, they're recording that at fair value. So they're not showing income from the gift, but they are showing the full expense, the economic expense of paying for pollution. And then 60%, the most common category, if they're given an allowance, they record it at nil. And then when they pollute, if they have a certificate to deliver to pay for that pollution, they measure that liability at nil because they're going to settle it with the certificate. So they're using the entity-specific measurement in IAS 37 rather than the market alternative in IAS 37 to measure the liability. Okay, so you can see it's fruit salad. Different companies are doing different things. Why the world doesn't think this needs to get fixed urgently, I don't really understand. And then there's yet another 15% that are doing other approaches. So when you read a set of financial statements and there are emission certificates involved, okay, you have to read the accounting policy to understand what that company has done. And if you're comparing it to another company in the same industry even, you need to understand what the other company has done. And there is a huge amount of variation in what different companies are doing. Okay, so it's a total mess is the way I would describe it. Okay, so the IFRIC produced a arguably not excellent interpretation. The EU kicked the interpretation out effectively, so the ISB withdrew it. And since then, it's just chaos. Okay, so we live with chaos because we've got 3 underlying standards that have multiple alternatives in them. So there's a whole huge combination of things that people can choose to do. And some of the things they do are outside of what is available under those 3 standards. How they get there, I have no idea, okay, because I don't think that should be possible. Okay, so to see that we can understand the economics and the accounting, we'll do a couple of case studies on this. So this is actually based on the Californian scheme that there is. Okay, so Tesla is a company that I've used in a case study to illustrate this before. But Californian law will give manufacturers of zero emission vehicles credits. Okay, and they're not going to have to hand those credits in because they're producing what California describes as not polluting cars. Okay, so they can sell their credits to companies that are producing, combustion engine cars. Okay, so they get a certificate that they can sell to somebody else. Okay, that's essentially what it comes down to. So Tesla gets lots of these by way of example. Okay, so if we look at a timeline, and we're just going to think about the economics to start with. So if we were manufacturing in this jurisdiction and this scheme came into place, and we are zero emission manufacturer, so we're making electric vehicles and not combustion engine vehicles. Okay, so our market capitalization would likely increase when this happens because we're going to get things that we can sell that we didn't have before. So we've got better cash flows than we had before because the scheme comes into place. So in our example, our market capitalization, we look at in the market, and the day the scheme's announced, it goes from 50 billion to 55 billion. Okay, then the government's going to grant us some credits, okay, and then we're going to sell some credits, and then we're going to observe in the market what credits are trading at that point in time at our balance sheet date, and we're first going to do the economics before we do the accounting, okay, because you have to understand the economics of anything before you can do the accounting for it, I think. Okay, so that's the economics. Okay, you see our market capitalization change. Does it make sense that it changes? Yes, because we've got a new cash inflow that we didn't have before. So we would expect our market capitalization to go up in response to that. Okay. Okay. So if you're looking at the economics, it would be the same as using fair value accounting for everything all the time, basically. Okay, so if we are looking at the scheme, and we're saying our market capitalization went up by 5 billion, okay, because the scheme came into being, because our future cash flows were now likely to be higher than they were previously. If you had to put that into, are my assets going up? Are my liabilities going up? My equity is going up by 5 billion, isn't it? So equity can't go up without assets going up or liabilities going down. Okay, one of those 2 things has to happen for equity to go up. And then do I have income or expense from it, or do I not have income and expense from it? So if you were accounting for everything, in other words, you were doing the economics, market capitalization has gone up by 5 billion. So equity has gone up by 5 billion. Okay, what's caused that equity to go up by 5 billion? I've got more future cash flows, don't I? Inflows. Okay, so would that be reflecting as an asset in my books, or would that be reflecting as a liability? So if you were doing a impairment test of your cash generating unit as the factory, would your value in use, your recoverable amount, have gone up or gone down because of this? It's gone up, isn't it? You've got more cash flows now than you had before. Okay. Everybody happy? Okay, so I'll do the first one with you. You can see that equity's gone up. Has a liability gone up? There's no liability from this. So it must be that asset has gone up. And that could just be reflecting the higher cash flows you're going to receive now from your existing assets. Is that income? For it not to be income, it would have to be a transaction with owner in their capacity as owner. Okay, if I'm Tesla, is the government my owner? Well, who knows now? Okay, but okay, so is it a transaction with owner in capacity as owner? No. So it's income. That's the definition of income, a change in an asset or a liability that's caused an upward change in equity that isn't from a transaction with owner in capacity as owner. So clearly it's income in economics. Okay, so in economics, we have income. Okay. If market cap's gone up, okay, then we have income in economics. Okay. So then what happens is the government grants us some certificates. Okay, so what do you think in economics happens when the government gives you some certificates? Okay, and then we're going to sell some certificates. So when they give us some certificates, okay, what do you think is likely happening in economics? Do you think assets go up? We've now got certificates we didn't have before.
Yes, asset is
Okay,
growth.
so assets are probably going up by the value of those certificates. Okay, is liability going up? Because you have to hand the certificates back? No, we don't. We never have to hand the certificates back. Okay, so what do we have? Either another asset must be going down or we've got income. Okay. And I think it is debatable about whether another asset is going down or we have income in this case. Okay, because if it was factored into the market capitalization increase that we had already, okay, then arguably another asset could be coming down because we've received some of the asset that now replaces another asset that we had. But in illustrating it, I've said we have income. Okay, but I would accept the argument that maybe another asset has gone down rather than having income in this case. Okay, so now we've got $1 billion income for the certificates that we've received. Okay, now we sell some certificates. Okay, so what's happening when we sell certificates now? Okay, so is there an asset going up when we sell certificates? We get cash. So there must be an asset cash going up, and there must be an asset going down because we have parted with certificates. Okay, so we've got an asset going up, we've got an asset coming down. Are those two of equal value? If we're selling at fair value, would they be at equal value? Yeah, it's got to be equal value. If we're doing everything at fair value all the time, all that happens when you swap is you're swapping an asset that's worth, what did we say in the slide, $500 million, okay, for another asset of $500 million. I've got cash instead of certificate now. That's all that's happened. Exchanging one thing for another of equal value does not give rise to income. Okay, so all that's happening is we're exchanging one asset certificate for another asset cash. That's all that's happening. Okay. Okay, so now we've still got $500 million worth of certificates, don't we? And the value of those certificates goes up by 50%. So from 10,000 to 15,000 each certificate. Okay, so what's happening in economics when the value of our certificate goes up? Does an asset increase? Yeah, asset's worth more, so the asset's gone up in economics, okay, by 0.25 billion. Okay, and what else has happened? Equity's increased, and do we have income? Yeah, we have income. Okay, so the economics is not difficult. Why are people finding it hard to specify the accounting if the economics is so simple? Okay, because it's easier to see if you are not a polluting company. Okay, it's easier to see for a company that's not a polluting company. Okay, but we'll look at a polluting company a little bit later. So carrying on with this example, so what happens in the accounting, not the economics now, okay, if our accounting is all done at historical cost? So this is what Tesla actually does. Okay, the accounting is all done at historical cost. Okay, so at historical cost, the carrying amount of our equity and assets, we just ignore liabilities, it would be net assets, but we'll just call it assets, is 5 billion. So going from 50 billion to 55 billion, okay, if we're doing things at historical cost, we're not adjusting for changes in value. Okay, so there would be no economics. You would pretend nothing happened, but now you've got future cash flows. Because that's what historical cost does. It pretends all the time. So we pretend that there's nothing changed when the scheme that gave us a whole lot of future cash flows came in. In our accounting, nothing happened. Okay. So we're going to account for our certificates at historical cost. What's the historical cost of the certificate? How much did you pay for the certificate? Nil. Okay, so Tesla accounts for the certificate at nil. Okay, so that's the same as not accounting for the certificate. Okay. Okay, so what would the accounting be when the scheme is introduced? Nothing. So we just ignore. Nothing happened. Okay. And then what would we do when we given the certificates? Remember, we had income in the economics. Now, nothing, because we record it at nil. So nothing's happening. So Elon Musk wants to manipulate his profit. You look, any quarter before it became a profitable car manufacturing company, any quarter it made a profit. All the profit came from selling certificates. Okay, it wasn't making profit from selling cars. It was making profit from selling certificates. Okay, and then does the analyst know how many certificates Tesla's got? No, the analyst has no idea because they recorded at zero. So the analyst doesn't know how many certificates. The cupboard might be empty. The cupboard might be full. The analyst doesn't know. Okay, historical cost accounting, absolute rubbish. Okay, you can see it again and again and again. Okay, and then the value of the certificate changes, it doubles. So we've still got half a cupboard full of certificates. The value changes, historical cost accounting, nothing. Okay, what have I done? Sorry, we sell some certificates. Okay, so sorry. Nothing happened when the value changed. We sell certificates, what happens? We've got cash. What's the cost of sales relative to that sales, if you want to put it there?
Zero.
Cost of sales is? The expenses?
No, it's zero.
Magic money machine, isn't it? Or magic profit machine. Whenever he wants profit to get a bonus, just sell some certificates. Okay, and the analysts pulling their hair out. They try and forecast what Tesla's future profits will be. Okay, and then they can never get it right. Why? Because, well, we don't know how many certificates he's got. He's probably got none. but you know, whenever he needs profit, he sells some certificates. And interestingly, Tesla in the old days was recording it as sale of car revenue. That's where the certificate revenue was showing up in sales. Cost of sales nil, okay, and sales. And what do you think analysts do with gross profit? A high multiplier, don't they? Okay. No wonder he's a politician now. Okay. Okay, and then I think this one was the certificate doubled in value. So we said there's no effect of the certificate doubling in value. Okay, so you know, look at all the things that we've had a look at, okay, and ask yourself, is any of this consistent with economics? Okay, so we looked at economics first, and then we looked at accounting. Is the accounting telling us anything about the economics? Nothing. Okay, it's just a waste of time. Okay. Okay, we don't know how many certificates he's got. So we don't know what the balance sheet value of it is. Okay, and we can't trust the gross profit number because, you know, that's including the sale of certificates as if they're cars. Okay, so you can see the problem. Okay, so it could be different. You could have a manufacturer like Tesla that might be using the fair value model for certificates, okay, but the cost model for other assets. So, you know, there are different accountings, as we saw from earlier, that could be done for this. So if we are using fair value model for our certificates, okay, but we're using cost model for everything else, we could run through it again. What would the effect of the scheme being announced? So our market cap's going up. Any change in our accounting? No change in our accounting because that's, you know, we haven't got a certificate yet. Okay, and then we receive some certificates. So if we're accounting for our certificates at fair value, we're going to get income from receiving our certificates. Does that make sense? Okay, and then the next one, we're going to sell some certificates. Okay, so when we sell those certificates, they're going to go out. They were in our books at $500,000. So we're exchanging, we're getting cash, we're giving up certificate. Okay, so you would see the gift when you receive the certificate. That's when you would have income, not when you sell the certificate. And the certificate doubles in value. Well, yes, if we're accounting for the certificate at fair value, we would see the increase in value in the certificate coming through in our accounting. Okay, so that's better than the alternative doing everything at cost. Okay, but it's still not perfect. Okay, so it's slightly better. Okay. Okay, so I do that one first, just because I think it's a little bit easier to see when you're not a polluting company. Okay, but now we're going to look at a polluting company under IFRS requirements, okay, in one of these schemes. Okay, so you're a heavy polluter. Okay, so the first event is you get this cap and trade, so you now have to pay for pollution. You never had to pay for pollution before. Okay, what effect is that going to have on a heavy polluter's market capitalization? So think if you and Serbia are in a common market, okay, and Serbia doesn't make their companies pay for pollution, but your country makes you pay for pollution. Okay, what's going to happen to your market cap relative to your competitor in Serbia? It's going to go down, isn't it? You have a cost they don't have, so your cash flows are going to be lower. Okay, and that's the problem with trying to fix climate change, isn't it? Everybody thinks it's a good idea we stop polluting, but everybody thinks they should just carry on doing their polluting and somebody else should stop doing their polluting. It's somebody else's fault. Okay, so that's the problem. Okay. Okay, so in economics, our market cap has come down, so our assets are impaired. Effectively, that's what happened. Our factory now has more outflows than it had before. So our factory is impaired relative to what it was before. Okay, so our factory is coming down, our equity is coming down. Okay, we then pay $4 million to buy some certificates. Okay, the government then issues us with some certificates. They were just a bit slow to give us ours. We bought some before we got given ours. Okay, then we pollute a bit. Okay, and then the fair value of our certificates doubles. Okay, so the economics is quite easy to see, I think. So before the scheme was announced, our market cap was 40. Okay, the scheme came, which we now had to pay for pollution. So our factory gets impaired, if you like, by 5 million, and our market cap goes down by 5 million. Okay, so after we've got net assets of 35 million, okay, factory of 35 million, and equity of 35 million. Okay, so in accounting, if in accounting we were using the cost model, so net assets, our factory was at 20, okay, and our equity was at 20. Okay, so now the scheme's announced. What do we do in accounting? Okay, so in accounting, how much are net assets and equity after? Is it 35 million like it was in the economics? Is it 20 million or is it 15 million? Okay, do you want to discuss with the person next to you? Let's put this one to a vote. 3, just 3 alternatives. Okay, so in accounting, are we going to end up with 35 million factory and equity, or 20 million factory and equity? Okay, what was it? 15 million factory and equity. Are we going to have an impairment in accounting? That's basically what you're asking yourself. In economics, you have an impairment. Okay, your factory has gone down in value by 5. Okay, in accounting, has your factory gone down by 5? Okay, let's see what they're saying in the Zoom room. So some are saying it's the same as the economics, some are saying it stays at 20, and a few are saying, okay, that it's going down by 5. It went down by 5 in the economics, so they're impairing their factory by 5 if you're in the third group. Okay, so let's take a vote in this room. Who says, okay, it's the same as the economics, so we're going to have our factory at 35 now? Okay, nobody. Who says our factory stays at 20? There's no impairment. Okay, and who says no, our factory is impaired by 5, so it goes down to 15? Okay, so if we were forecasting cash flows for our factory, in the economics, our factory was worth 35, wasn't it? So when we do our value in use impairment test and we forecast our cash flows, we come back to a number of 35. The factory's in our books under cost model at 20. Do we impair our factory? No. Recoverable amount is much higher. Why? Because we're using a cost model, and a cost model's rubbish. Okay, if we were using a revaluation model, yes, we'd impair our factory. But we're using a cost model, so we're pretending that our factory wasn't worth what it was worth. Okay, so we pretend it's not impaired now. Okay, so it's the big pretend, isn't it? Okay. Okay, so this accounting has got nothing to do with capital maintenance. Okay, so there's a conceptual discussion around capital maintenance, but that is outside of how IFRS is working for this transaction. Okay, so we can discuss that separately. Okay, so no impairment. Why? Because we're in cost model. Cost model pretends our factory was only 20, recoverable amount is 35, no impairment. Okay, so the next thing that happens is we purchase some certificates in the market. So we pay 4 million, so we exchange one asset for another asset, don't we? Cash goes down by 4 million, and we get emission trading certificate asset 4 million, don't we? Does that make sense to everybody? What happens in the accounting? So in the accounting, what is net assets and equity after? Is it still 20 million? Is it 16 million? Is it 15 million? Is it 35 million? So in accounting, what would you do for that transaction? You parted with cash, so your bank must come down, and you received a certificate you paid for, so certificate asset must go up. So it's going to be 4 million in, 4 million out of assets. Okay, so no change in equity, no change in net assets. Does that make sense to everybody? You're still at 20 million. Okay, so then what happens in our next step? Okay, the government grants us some certificates. So they give us certificates that are worth 4 million. So now we've got 8 million's worth of certificates. We bought 4 million and they give us 4 million. So in economics, we've said we've got a new asset, 4 million, and we've got income of 4 million. That is debatable, okay, but let's stick with that being the economics. Okay, so what's happening in our accounting? Okay, do what you want accounting. Okay, everybody's doing something different. Some people will say, I'm recording it at 0. Some people will say, I'm recording it at 4 billion or 4 million, whatever it is. Whoops, sorry, 4 million. Okay, so do what you want. Okay. You see the problem. That's bad accounting, isn't it? Letting some people use 4 million and some people use nil. Why is the world happy with this? We should be very unhappy about this. Okay, this is bad. Okay, so this is the diversity in practice. It starts here. Okay, and then the next thing that happens is the certificates double in value. So in economics, they become worth 8 million more. The 8 becomes 16, doesn't it? So our equity goes up by 8 and our assets go up by 8. In accounting, what happens? Well, nothing if I'm using nil, okay? Or I could be doubling like the economics up to 16. And some people will be doing fair value on some of them, the ones that I bought, but not doing fair value on the ones I was given. Why? Okay, it's weird. Okay, so there's all sorts of things that are happening here. Okay, and then why is this nonsense happening? Okay, and the one thing I haven't covered is actually, well, what happens when you pollute? Because that was in the question. We then polluted, didn't we? Okay, if I can just find it. Okay, so we polluted 500 certificates worth. Okay, so we've got a quarter of what we've got, we now have a liability for, don't we? Some people will record that at fair value, the liability, and other people will say, no, I'm going to pay for those, I'm going to deliver 500 certificates that I've got in my books at nil to settle this liability. So my liability is nil. And other people will say, even though my certificate's at nil, I'm going to record the liability at fair value. So you can see there's total chaos here. Okay, so everybody's doing something different. Okay, and nobody's saying, please sort this out quickly. Okay, they are beginning to say that now. Okay, but crazy. Okay, everyone happy? You understand more or less what's happening here. Okay, so what is the problem? Why aren't people understanding what's going on here? And I think the problem is because we use cost model accounting for our factory, so people don't see the impairment of the factory because the 20, when the scheme comes in, the factory's value dropped from 40 to 35, didn't it? Okay, but they were accounting for the factory at 20, so they don't see the impairment. So they want to match the income from the certificate to when they pollute. But if they used the revaluation model and showed the impairment when the scheme, when they had to start, they would want to match to the impairment. So the economics is it should relate to the impairment, not to when you pollute. The introduction of having to pay for pollution impairs your assets. That's what it does. Okay, you have to pay for pollution. Other people don't have to pay for pollution. Okay, so your factory gets impaired. But because you don't see the impairment of the factory in the accounting, people think you get a mismatch because you show income now when you have the impairment, but you don't see the impairment. And then when you pollute, you're going to have expense for pollution. Okay, so they think this income now should be matched to the expense pollution. But this income now should be matched to impairment, shouldn't it? Okay, because if you did revaluation model, you would all see that economics immediately. So it's the cost of not telling the truth again. We can't keep track of all our lies. Okay, so we start not understanding the economics of what is happening here. This is compensation for the impairment. It is not, matching to when you pollute. It's the effect of having to pay for pollution on your factory now. So that's where it should be matched to. Okay, but you don't see that, so people want to start matching it elsewhere. Okay, so it's hard to help people sometimes. Okay, so the root cause of this problem is that we use a cost model and that we don't recognize many of our assets. Okay, so we were just speaking about factory asset here, but there are other assets as well that we don't recognize, like brands and things that could be affected as well. Okay, so it's the recognition problem and the measurement problem. Okay, that's what's causing the problem. When you start telling lies, you have to tell compensating lies. Okay, and that's kind of the space that we're in. Okay, interesting stuff, isn't it? Okay, so just looking at the time. Okay, well, let's carry on for 10 minutes because the tea isn't here. So we'll start on the connectivity issues and then we'll stop when the tea comes for tea. Okay, so we've discussed connectivity a little bit already. We've discussed that the regulators are beginning to look at this. They're looking at the other information that you're providing and saying, why aren't I seeing the related effects in your financial statements? They're expecting to see the effects in your financial statements, and they're beginning to ask questions where they don't see the connection. And sometimes it's as simple as explaining why there is no connection. Okay, like in our example, there is no impairment because we're using the cost model and our factory is a much lower value than, you know, its fair value, basically. So that's why you don't see the impairment. So you just need that connection made. Okay, so we're expecting to see this. We're expecting to see judgments and discussion about those judgments. And we're expecting to see consistency between what you're saying outside your financial statements and what you're saying inside your financial statements. Okay, and when you do come to do the sustainability reporting, you will see that the reports are supposed to be published at the same time, the sustainability report and the financial statements, the same reporting period. Okay, and they should be cross-referenced at least to one another. So you should be able to, when you look at your sustainability report, it should tell you the financial statements to which that sustainability report relates. Okay, so the connection should be very clear between these documents. Okay, so that's coming soon. If you are going to use IFRS sustainability reporting, it's the same materiality. If you decide to use GRI or ESRS, it's different materiality, as we've discussed already. So then you'll have a disconnect between the materiality that you use in your financial statements and the materiality that you use in your sustainability report. Okay, so it makes the connection a little bit more difficult, but it can be done. Okay, it's supposed to be the same reporting entity. And if it's IFRS, it's focused on the same primary users, investors, lenders, and other creditors. Okay, so it's the same information need, the same materiality judgment, just a different set of information to which you're applying those judgments. Okay, you try and use consistent data and assumptions in the two sets, what you do in sustainability reporting and what you do in financial reporting. Sometimes the requirements require you to do something different. Like if I'm doing historical cost and financials, okay, and in my sustainability report, I'm speaking about the effects on all my future cash flows, I'm not necessarily seeing that in historical cost accounting. Okay, but to the extent that you can, your data and assumption should be consistent in the two sets of information. And interestingly, under IFRS sustainability disclosure standards, okay, we use the presentation currency from the sustainability standards as the currency that we present our sustainability information in. So that's a little bit interesting because in IFRS, you determine your functional currency, you choose your presentation currency for your financial statements. But for your sustainability report, you must use the presentation currency that you used in the related financial statements. Okay, which is interesting to me. Okay, so we've spoken about in IFRS, you should avoid cluttering. So one of the materiality rules is you can't cloud out material information by surrounding it with too much immaterial information. You're not allowed to clutter. So many regulators are now looking at financial statements and saying, why are you disclosing all this immaterial information? Because you're hiding material information. So you're supposed to, when you prepare financial statements, not just make every disclosure that IFRS says. You're supposed to say, can I strip some of this out because it's not material? Okay, so then you're left with what is material. Okay, so you're not allowed to clutter, basically. Okay, whenever I review financial statements, I see cluttering. Okay, so only a very few companies are doing a very good job of this. Okay, where they are decluttering their financial statements. Okay, So it is a difficult thing to do. It's much easier just to say, there's a disclosure requirement, I'll disclose whatever it says. Okay, that's easier to do than to sit back and say, let's strip out now what's not material. Okay. Okay, so that's interesting. And then we'll go through some examples just as sort of little case studies. So in this first example, we're looking at in our sustainability information outside our financial statements, the company's telling stories about how it began the commercial production of a new, more climate-friendly product. Okay, so it's replaced an old product with a new product. It's got many products, but it's just replacing one old product with a new product. Okay, so, and it's developed this new product itself. So it has developed the product and it's now begun commercial production of that product. Okay, so this one, if we run the multiple choice, we want them to be able to select more than one right answer. Okay, so there's more than one of those things that is going to be relevant. So when you read that information outside the financial statements in the sustainability report or the company website or somewhere, you hear that this is what they have done. What do you think you will see in their financial statements in relation to that thing? So they have developed a new product and they have put it into commercial production now. So in this year's financial statements, they have put the new product into commercial production. So what does that trigger in your mind? An expectation about what you will see in their financial statements. Okay, because that's the exercise you're doing. You're thinking, I've read this. This is what I expect to see. If for some reason it's not material or something, it's not disclosed, then the connectivity would be, well, why was it so important you were telling me about it over there? Okay, if it's not material here, because it's the same materiality in and out. Okay, so if it's material there, I think it's probably material here too. And if it isn't, then you need to tell me why it's not showing up here. So the example we've had so far, maybe I was using cost model, it's an impairment issue. So it wasn't impaired under a cost model, even though the value came down of our factory. So you would just expect that connection to be made for you. Okay, so where are you expecting to find financial information in your financial statements about this new product that this year has been brought into production for the first time? So it's happened because you've developed a more environmentally friendly product because that's what the market is seeking. Okay, so where are you expecting that to show up in your financial statements, information about that? Okay, so you can select more than one of those. Okay, and this is the last one we're going to do before tea break. Okay, so we're seeing quite a few of different ones being selected. So hopefully in the Zoom room, you're choosing more than one. If you think more than one is relevant, more than one is likely to show up. Okay, so we should be getting multiple selections by each person. Okay, so it's a new product that's been developed. So what do you think you're going to see in the financial statements? Do you think you're going to see research expense? I think that was the first one, wasn't it? Research expense. Are you going to see research expense? No, research probably happened like a few years ago. Okay, so that would have been expensed as it happened. We've then taken it through the development phases. So through the development phases, what are you expecting to see now? If you finished development, you should have had some capitalized development costs. Okay, so you would expect to see some capitalized development costs. What would now be happening to those capitalized development costs?
Amortization.
Would they be just sitting at cost or would you be amortizing them? You're probably amortizing them now because you're using the development recipe up, aren't you? You're consuming its service potential. Okay, so you're probably seeing amortization of development costs. Okay, so you can see the kind of thinking that we're going through. Okay, where would development costs be sitting in your balance sheet? What part? Intangible assets? Okay, so what models do you have for intangible asset? Cost model or revaluation model? Do you have to use one of the models, or do you think you could choose either model? Can you choose? No, you can't choose. You can only choose for an intangible asset where you can measure with reference to an active market. There's no active market for this secret recipe, is there? Okay, so you have to use cost model for this. Okay, so those are some of the things you'd be thinking about as you look at this. There might be impairment. Okay, if you're doing new stuff, you sometimes get it right, you sometimes don't get it right. So there might be impairment of your asset. It's possible. Okay, hopefully not, but it's possible. Okay, so those are the types of things. So it'll be multiple of those things that you would be expecting to come up. Okay, shall we break for tea? So half an hour for tea, and then we'll carry on with examples. Okay, so let's go on with what we've got. So now we are looking at a company, okay, which is facing a decreasing demand because its products are environmentally unfriendly, and people are moving away to competitors' products that have evolved to be more environmentally friendly. Okay, so I think quite a few old businesses face this particular problem. So if this is the company that you're auditing, if this is the company that you are the CFO of, then what are you expecting to see? So all that's happening in this company is the product they are selling is getting less and less desirable because people are shifting to more environmentally friendly alternatives that are available. Okay, so what recognition and measurement and disclosure do you expect to see in the financial statements to do with the fact that people are shifting away from this company's products to other companies' products? So what are the financial effects of that happening that you would expect to see in the financial statements? Are you expecting to see non-current assets held for sale? Are you expecting to see jobs getting lost? Are you expecting to see depreciation estimates change or even stop depreciating? Are you expecting to see impairments? Are you expecting to see a profit on loss on the sale of assets? Okay, so I think if we open a poll, you can select as many of those as you want. So if we do the multiple choice, the multiple alternative selection poll. In the room, chat with the person next to you, that's fine. Okay, just see what they think. Okay, so your cash flows are getting shorter, basically, because people aren't that keen on your product anymore. So when that is happening, okay, there's likely to be consequences, aren't there? There's likely to be impairment testing. There's likely to be considering to replace your existing machines. There's likely to be redundancies. Okay, there's, so all those things on that slide are likely to happen, aren't they? Okay, they might not all be happening at the same time, okay, but you would have an expectation that at least some of those are happening. So I think we can close the poll. Okay, so you can see people coming up with just about everything that's on that slide. Okay, so if you're reading that in the sustainability report, that's what you're thinking you're going to see in the financial statements. If you're not seeing it, you want to understand why you are not seeing it. Okay. So the next one we're going to have a look at is from the entity sustainability disclosures. You see that they have an interest in an associate at 30%, that the associate's main asset is a factory, and they're recording the greenhouse gas emissions, but they're including the greenhouse gas emissions in the company's greenhouse gas emissions. Okay, so if you do equity accounting, you're accounting for an investment, aren't you? Okay, so if you're accounting for an investment, then if you're familiar with the greenhouse gas protocol, then investments would tend to be Scope 3 greenhouse gas emissions. They're not your greenhouse gas emissions. They're greenhouse gas emissions that are happening in your value chain. Okay, so your expectation would be, from an understanding of financial reporting, that if you have an associate, you are accounting for an investment asset. So you would expect to see Scope 3 greenhouse gas emissions in respect of that investment. You wouldn't expect to see Scope 2 or Scope 1 greenhouse gas emissions. So Scope 1 greenhouse gas emissions are the emissions from whatever you do at your factory emitting directly at the factory. And then Scope 2 is the emissions that relate to bought-in energy. So whatever the national grid electricity factor is for greenhouse gas emissions, what you import from that grid is your Scope 2 greenhouse gas emissions. So from a financial reporting perspective, from a financial statement perspective, we wouldn't expect to see Scope 2 or Scope 1 greenhouse gas emissions for associates. But the greenhouse gas emissions and the IFRS S2, the sustainability report, and I think the EU SRS, I'm not sure about that, I'd have to check that, give you a choice when you're reporting your greenhouse gas emissions for associates. You can use an equity share if you like. So you choose equity share or control. If you choose financial control, then it would be consistent with what you have in your financial statements. But if you choose equity share, it wouldn't be consistent with what you have in your financial statements. So it's just to point out that whilst we say we're doing the same thing in our sustainability reporting, we have the same reporting entity in both, well, yeah, in the detail, it's a little bit different sometimes. Okay, so, you know, sustainability reporting was brought together very quickly from a whole lot of different sources and isn't as pure as financial statements are. So you have to just understand where there are these inconsistencies, and there's a choice in your greenhouse gas emissions reporting to use, in effect, what looks like a different reporting entity boundary from what you have in your IFRS financial statements with regard to associates. You can use the same reporting entity boundary, okay, but there is this greenhouse gas emissions on associates where you could instead choose to use an equity share approach rather than the consolidation, or in this case with associates, the investment approach, which would be Scope 3. So that's maybe a bit beyond where we are right now, so we shouldn't spend too much time on that. Okay, so this is one of the examples that is in the exposure draft, which the IASB has out right now. Okay, so this example is not going to be part of IFRS, but they're proposing it gets added to the illustrative examples that accompany IFRS. Okay, and this is dealing with credit risk management practices that consider climate risk. Okay, so in your IFRS 9 reporting that you do with Daryl this afternoon, when you're doing the expected credit loss model, where climate risk is relevant, you're going to be factoring climate risk into measuring expected credit losses. Okay, so where you are doing that and it is material, it's going to come out in your disclosures that you make under IFRS 7 about your expected credit loss application. So your forward-looking information would include climate-related risks, for example. Okay, so the types of places where you're likely to see this is if you're lending to agricultural customers, for example, and agricultural customers are subject to drought and flood. And I come from a farm. I don't know why anybody would do that business. Okay, you not only have to work, you know, you're dealing with the climate all the time is determining whether you can make a profit or not. So it's quite a difficult business, I think. Okay, so when banks are lending to farmers and farmers are subject to drought, flooding, increasingly with climate risk, okay, that's probably factoring into the price that they are charging for the loans they are making to farmers. Okay, so if that's affecting how you're pricing credit risk, then it should be coming out in your IFRS disclosures about financial statement risk for expected credit losses. Okay, so you can see, and some of these loans can be quite long-term loans. So obviously, the longer the term of the loan, okay, the more exposure you have over a longer period of time. Okay, and then for real estate loans, for mortgage loans, for example, okay, flood risk is a big problem now. Okay, so you know, you're probably factoring that into the pricing of your home loans now. Okay, or not just home loans, but it could be factory loans. If the factory's built in a floodplain, okay, you're going to have to charge more interest, aren't you? Because if you don't, okay, when you call in the collateral after the flood, you find there's nothing to call in. Okay, go to the south of Spain or the east of Spain if you don't believe this, okay, and you will see for yourself banks now looking for their collateral, which doesn't exist anymore. Okay, so you can see the types of things that people are factoring in. And if the bank's not factoring it in and it exists as a risk, bye-bye bank. Okay, so, you know, banks are specialists at pricing risk, so they should be doing this already. Okay, and probably are, and insurance companies almost certainly are, because they're at the forefront of this. Okay. So, you know, if it's material, and it would be material in the types of industries we've just had a look. So when you're lending in those industries, it's going to be material to you. So then you have to make all sorts of disclosures about how you are pricing that credit risk, or how you're factoring in climate into those credit risk disclosures. So the disclosures, and I'm not sure if Daryl will go through with you them this afternoon, but paragraph 35A to 38 of IFRS 7, which you're going to have the joy of doing soon, okay, will be setting out the types of disclosures that you have to make. So how is it factoring into your credit risk management practices? How is it factoring into the recognition and measurement of your expected credit losses? Okay, so, you know, how are you looking at when you're looking for, is there been an increase in credit risk to step from, you know, one level of impairment to another level of impairment? Okay, so, you know, stage 1, stage 2, stage 3. Okay, and then when you're grouping financial instruments together, you should only be grouping things together that have similar risk profiles. So you're probably considering that if you have property loans in areas that aren't subject to flooding, and property loans that are in areas that are subject to flooding, with flood risk being significant in some jurisdictions. Okay, and you think of Spain as a dry country, it doesn't rain there. Okay, but when you get a year's rain in a day when it does rain, okay, so if you're in the floodplain and you know, the planners have allowed development like they have in the UK to happen in the floodplain, okay, you have a problem. Okay, so you're probably pricing that in when you are pricing your credit risk. Okay, and there'll be all sorts of modeling happening about, well, right now there isn't a flood risk, but if the climate becomes, if global warming goes up a little bit more, then the climate becomes that much more unstable. It's a 20-year loan, so in 20 years, how much more unstable is the environment going to become? And I'm factoring that into the pricing now. If I'm not, bye-bye bank. Okay, so you can see why this is important. Okay. Okay. So, you know, these are the types of disclosures. This section 5.5 is dealing with impairment. So these are specific disclosures that you might expect to see with regard with what Daryl will be taking you through this afternoon. And I'm sure he'll be focusing on the expected credit loss model. So it could be affecting your probabilities of default. It could be affecting your loss given default. It could be affecting your should be affecting your forward-looking information. It could be, on the next slide, affecting the level of collateral that you have, okay, and whether that collateral is, you know, going to be there when you come to recover after the flood. And then identifying concentrations of risk, so separating what's in the floodplain from what's not in the floodplain. And the better banks are, you know, doing geolocation on all the individual properties now. So the quality of that data is going up very quickly, and the insurance companies obviously too. Okay, so the quality of data about climate risk is improving in the world very quickly because we're beginning to see the risks manifest. So we have to start pricing, particularly on longer term products, okay, before the problem manifests. Otherwise, we price incorrectly. Okay, so you can see that this is a very real thing that's happening right now. Okay, so more from Daryl on that this afternoon. Okay, but in the climate context, okay, that's where you are seeing it already in IFRS financial statements. So in that exposure draft that gives examples, when you read IFRS 9 now and the illustrative examples on IFRS 9, you look at forecasting, you know, working out your expected credit losses. It's not saying anything about climate. Okay, but because when IFRS 9 was written, people weren't particularly worried about climate. It wasn't that long ago, was it? Okay, now they're very worried about climate. So suddenly, you know, this is important when you're working out expected credit losses. So, okay, so now we're adding examples. We're backfilling examples, if you like, to tell people the requirement's always been there. We just didn't specifically identify this as something you would be doing, but obviously you should have been doing it. Okay, so this is one that the board that I sit on, the staff came up with as an example, and I think they found these examples by going through UK companies' financial statements and pulling out where they thought they saw things that might be climate related. So some company was saying that they were introducing bulk fuel carriers, okay, and they're just replacing the old ships with new ships. Okay, so these new ships will be more environmentally friendly than the old ships, basically. So they're working on ships now that have sails to, you know, if you're crossing the ocean and the way the wind's blowing, you don't really need to burn fossil fuel. Okay, but when you're going the other way, you have to burn fossil fuel. So they're working out ways of, you know, trying to cut down the amount of emissions that they have with these ships. So this is an example of, you know, a company saying, well, the way we plan to get to net zero is to try and phase out our polluting ships and bring in less polluting ships. Okay, so this is part of their plan. So they're telling you about this plan outside their financial statements. So when you read this outside their financial statements, what do you expect to see in their financial statements? Okay, so the question is, okay, what aspects of its financial statements do you expect could be materially impacted by this? So when you're reading their financial statements now, if you have read this outside their financial statements, what effects do you expect to see in their financial statements? Okay, so this is climate related. They're doing this because they want to emit less CO2. Everybody is going to be emitting less CO2. The world is going to a less CO2 emitting environment. Okay, so everybody's changing in that direction. This company is saying our plan to move in that direction is to replace more polluting ships, because we're a shipping company, with less polluting ships. Okay, so what effects would you expect to see in their financial statements? Okay, so come up with maybe 5 things you would expect to see in their financial statements. Okay, so chat with the people around you, come up with 5 things you would expect to see in their financial statements. Okay, and if you're in the Zoom room, think of 5 things that would affect your financial statements. Okay, and don't type them in yet. We'll ask you to type them in when we're discussing it. Otherwise, you'll be helping everybody else. Okay, so when I do this with my students at the university, we go 1.5 marks for every good point you make, 1 mark for okay point, 0.5 mark for okay, there's something there, okay, and then 0 for things that are just not relevant. Okay, so maybe if we go from the Zoom room first, is there anything that anybody wants to suggest that you might expect to see? Just type it into the chat. If there's anything you think we should expect to see in financial statements when we have seen this statement outside of the financial statement. So we'll just give you a moment to type in some of the things you think we might see. Okay, so let's just give them a minute to do that. So you can carry on working out what your 5 is, your top 5. Okay, and we'll see how many marks you can get. Can you get 7.5? Okay. Okay, we need more than one. Okay, so we're going to need, okay, so we've got two at least coming in. Okay, so before that goes off, I saw impairment of assets, 1.5 marks. Okay, there might be something going to IFRS 5 if you committed to selling something, another 1.5 marks. Okay, so that's good. Okay, the waste, the greenhouse gas emissions, those aren't really published in your financial statement. So you'd see those in your sustainability report. So you would see that if you're doing a sustainability report, but we're thinking more of financial statements. So unless there are particular costs associated with that, so if you had to pay for pollution, for example, you might see it in the financials. So that one we give maybe 0.5 mark to. Okay, loss on impairment we've done already. So PPE. Okay, what is it about PPE? Okay, lower fuel cost we're not going to see in our financial statements. Okay, higher depreciation. So changes in depreciation estimates. Yes, we might see changes. Okay, you may or may not see changes. So maybe you're going to replace your ship quicker. Okay, nobody wants your old ship. So maybe, okay, you know, it could be a change in depreciation. Okay, so those are some of the things we'll see. Okay, anything else that they haven't mentioned that you want to test quickly, that you came up with in this room? Anything else? What do you mean by reservation? Okay, so creating some kind of fund, maybe. Okay, 0.5 mark. Okay, so it's not impossible, but it's not kind of core to what we're looking for, but all the 0.5 marks count. Okay. Anything else anybody thinks? Okay, so think about some disclosures that you might have. There's still some 1.5 marks up for grabs here. Yes?
I think this is the disclosure. This is the
Oh, okay, just repeat that story. 0.5 mark. They all count. Okay. So do we have to disclose capital commitments? If you committed to buying a new ship, do you have to tell people about that? Yes. Okay, so property, plant, and equipment disclosure, capital commitments. Okay, 1.5 marks. Okay, so that's another one I can think of offhand. Anything else anybody has they want to test? Okay, it's a bit subjective when I'm saying grading is subjective. Okay, it's not a pure science. Okay, so yeah, I mean, you could start getting imaginative and thinking about maybe I've entered into, I've got emission certificates, or I've, you know, there are all sorts of things you could think of for not 1.5 marks. Okay, but yeah, okay, so I think that gives us a picture. Did anything else come up in the expected credit loss? Well, if I'm a bank lending to people that have, but we were actually the shipping company, so I don't think the shipping company would be affected particularly by expected credit losses on that. So it's more from the shipping company's perspective, the impairment of its old ships, the change in depreciation of its old ships. If you had raised a provision, there might be a remeasurement of the provision to the extent that you have polluted, but you haven't paid for the pollution, and the cost of paying changes as the value of these things goes up and down. Okay, so there's probably 0.5 mark sitting in that one. Okay, I think we can go on to the next one, but you can see the types of things you would expect. And if you're not seeing them, now we expect connectivity. We expect somebody to tell us why we're not seeing them. Okay, so those are the kind of things. You could have said, well, if I'm using the revaluation model, maybe instead of the cost model, then the value of these ships is coming down. So maybe I would have a reversal of a prior period revaluation, something like that. Okay, so there were some possible other things that you could have come up with. Okay, this is just the very quick list of things that that we thought of. So if we can just realign the presentation, there we go. Okay, so that's working again. Okay, so now you're a manufacturer of household products. Okay, so you're making cleaning things, okay, and cooking things, those kinds of things. Okay, so to reduce, you committed to reduce your greenhouse gas emissions today. In December 20x0 today, you commit to reducing your greenhouse gas emissions by at least 60% by 9 years' time. That's far enough away now that I can make any promise I like, isn't it? Okay, because I'll be gone, there'll be a new CFO by then, and it's not my problem. Okay, so that's the kind of promise this is. Okay. But when you get to 20x9, you've said, and you committed to this publicly, if when I get to 20x9 and thereafter, if I haven't reduced by 60%, I'm going to buy certificates or surrender certificates to pay for that pollution. So I'm going to buy on the market the certificates I need to offset that pollution. Okay, so that is from 20x9 onwards, I'm going to do that. I'm making the promise today. So 20x9, my pollution's down by 60%. If when I get to 20x9, it's not down by 60%, then going forward, I'm going to buy certificates to get it down to 60%. Does everybody understand the promise we're making? Okay, everybody understand the promise? Okay, so now when you're looking at 20x1, let's just say, okay, and the way you say you're going to get there, just carrying on with this example, is you're gradually going to modify your manufacturing processes. And by doing that, you think you will get down to 60% less pollution. Okay, so that's how you think you're going to get there. By investing in more energy efficient processes, buying renewable energy sources, okay, lower in carbon ingredients, those sorts of things. And you're confident you're not going to become loss-making. This is all achievable at a profit. Okay, so you're not thinking about onerous contracts, basically. Okay, so now at 20x0, the day after you made the promise, do you have a provision liability? So this is what the Interpretations Committee was asked to think about. Do you have a liability at 20x0? You've made a promise that sometime in the future, you'll be net zero, or in this case, only 60% reduction. And if you're not 60% reduced by then, at that time, you will buy certificates so that from then on forward, you'll buy the certificates needed to be 60% reduced pollution. So today, because I made the promise yesterday, do I have a liability today? Do I have a present obligation? Okay, so can we say a yes or no on that? Can we just run a yes or no? Okay, yes, I have a liability. No, I don't have a liability at this point in time. Yes or no? Okay, this is what the Interpretations Committee was asked. Okay, because some people were saying, okay, I'm reading all this net zero stuff you're promising me, and I look at your financial statements and there's nothing. So are you doing something wrong? So it goes to the Interpretations Committee. Okay, so the Interpretation Committee has to say, yes, there's a liability, or no, there's no liability. Okay, so let's run the vote. So we've got some yeses and we've got some nos. Okay, so in this room, yes, I've got a liability. No, I don't have a liability. Okay, no, you don't have a liability. Okay, what's your liability for? Okay, so you've made a promise that you might do something in the future, or that even I will do something in the future, but the future hasn't come yet. Okay, so if you think of the example that currently is in IAS 37 about fitting smoke filters, for example, so even if the law requires you to do it, okay, it's in the future. Okay, so no liability today. Okay. You just don't have a present obligation to do anything today. So if you're going to get a new machine to replace your old machine, you're going to exchange cash for new machine, aren't you? Okay, so there's no liability today. Okay, so there's no liability today in that one. Okay, so now let's just clean that one out. Okay, so then we get to, okay, so just going on from that one if we can. Okay, so no provision at this point in time, but you might have overarching disclosures, you might have depreciation, all those things we've discussed before, but no provision. Okay, because you don't have a liability at this point in time. Okay, so now you get to the end of 20x9. Okay, so the end of 20x9, and let's say you've only managed to reduce your pollution by 50%, and you had promised to reduce it by 60%. So you haven't reduced it by as much as you promised you would reduce it by. Do you have a liability now, end of 20x9? Okay, yes or no? Let's run the poll again. Yes or no? Do I have a liability? I haven't reduced pollution by as much as I said I would reduce pollution. Okay, so I've raised a promise now that if I haven't reduced pollution by as much as I said I would reduce pollution, I have an obligation to surrender certificates now. So I have a liability, don't I? I now have to pay for pollution. Even though legally I'm not necessarily required, I have at the very least a constructive obligation, which meets the definition of a provision. Okay, so what is my liability? My liability is how many certificates do I have to surrender? Okay, and then how do I measure that liability? Oh, why does life have to be so difficult? How in accounting do you measure that liability? How do you measure a provision? Okay, we discussed this earlier. Remember, these are those same certificates. If I've got the certificate in the cupboard and it was given to me at nil, I can measure the liability at nil. But if I haven't got the certificate, I have to buy the certificate, then what's the market price of the certificate today? And if I'm accounting for the certificate I have at fair value, then the liability surely should be the fair value of the certificate that I've got. Okay, so there's still a bit of it depends in here, isn't there, about how you go to measure that liability. Everybody happy? Okay, it's interesting stuff, isn't it? Okay. Okay, if we go back to the, thanks. Okay. So the promises people are making today, net zero by no liability. Okay, but when they get to concrete things that they have to have done by that point in time and they haven't done it and they've promised to do it, okay, then you get to liability. Okay, so it's a more interesting one. Okay. Okay, and then of course there's all these other things that will be going on as well in the financial statements, the overarching disclosures, the depreciation estimates, the impairments, the capital commitments. You might have fixed price forward contracts. There's all sorts of things that you might have, okay, that you would be thinking of. Okay, the other thing I wanted to do with you is a big case study, which I don't think has been translated into the Macedonian language. Okay, so when I last looked, it was only there in the English language. Okay, but okay, if you're going to understand this properly, you need to work through case studies. Okay, so I'm just going to take you at a very high level through the case study. Okay, so I'm just going to ask you questions on what we've done so far, provide you with a little bit of information, and you just answer the question. Okay, so this is the quiz to see you have understood everything that we have discussed today, basically, using a real world company. IAG is British Airways, Iberian Airways, A whole lot of European airlines basically together in one company. Okay, so some generic questions. You don't have to know that it's an airline even to answer this. Is the reporting entity for IFRS financial statements the same as the reporting entity for IFRS sustainability disclosures? Yes or no? Is the reporting entity the same or is it different? Okay, let's run the poll for each of these. Okay, so it's one or the other, yes or no? Is the reporting entity the same? Okay. So I always say to my students that this is a 1.5 mark question. So you're just saying yes or no. Okay, if I made it a 4.5 mark question, the answer would be it depends. Okay, so this is the 1.5 mark question. At the high level, is it the same or isn't it the same? Okay, so yes or no? Yes. Okay, yes, at a high level, it's the same. But in the detail, are there some differences? Yes. Okay, because this standard writes, some exceptions, and this standard, I mean, you could have investment entity under IFRS, for example. The investment entity exception is making all your subsidiaries look like investments. So your reporting boundary is different now, isn't it? Okay, so in IFRS, there's some exceptions in the financial statements. In the sustainability reporting, we looked at the equity, the associate where you could take a proportionate share, which you can't do under IFRS Accounting Standards. So there are some small differences. So if you took no, you maybe wanted to provide the higher quality answer, okay, but you answered the wrong question. You were asked the straightforward question at a high level, is it the same or not? Okay, so comments. Yeah, value chain is an example. Yes. So that is in the detail. So you're answering the 4.5 mark question. Okay, not the 1.5 mark question. So if it was the 4.5 mark question, you could mention from IFRS financial statements, investment entity, 1.5 marks, value chain. Okay, if you're in the sustainability standards, 1.5 marks. That equity method thing we were looking at, 1.5 marks. Okay, so you could make it a 12 mark question and come up with all the little differences that exist. But at a high level, the IFRS Foundation, and I think even the sustainability standards themselves say it's the same reporting entity. But it's like everything, we put all leases on balance sheet, don't we? But no, we don't. Okay, so in the detail, there's always some difference. Okay, so looking at the next one. Okay, so are IFRS financial statements and IFRS sustainability disclosures focused on the same user needs? Okay, let's run the poll again. Yes or no? Are we focused on the same user needs if it's IFRS sustainability disclosure standards and IFRS financial statements? Same user needs or different user needs? Okay, and it's the 1.5 mark question, not the 3 mark question. Or 4.5 mark question. Okay, so in the Zoom room, yes seems like the popular answer. In this room, yes? No? Okay, what's different? Okay, so you're answering the 4.5 mark question. So let's see if you know what is the difference. Okay. So you're saying one is dealing with sustainability and one is dealing. Okay, but we're asking about the users. Who are they? So
because
it's the users using different pieces of information.
Some regulators use the financial. Some regulators use non-financial information in the reports.
Okay, so maybe what you're thinking, okay, which is a different question from the question that we're asking you, is if you were doing ESRS or GRI, then the focus is different because they not focused just on investors, lenders, and other creditors. They focused on information for society. So it could be, you think it's just a different sustainability framework than the one that we're using. But what is different? Okay, so if it's the 4.5, so if it's a 1.5 mark question, it's the same. But what is different? Does anybody know? There's something strange in this. So the sustainability standard also says it's general purpose. It's focused on investors, lenders, and other creditors. Okay, but then in IFRS financial statements, we say it's only those who aren't in a position to demand information from the entity. So if we're doing Tesla, we're not giving information to Elon Musk. He can get any information he wants about Tesla. So in IFRS, we're not focused on the controlling shareholder. We're focused on people who can't demand information from the entity. And for some reason, the sustainability standards don't say that. Okay, and I don't know why they don't say that, but they don't say that. So there is a small difference. And it's not accidental that there's a small difference, okay, because you wouldn't leave that out. And I think that's important. So when you're in IFRS accounting standards applying the IAS8 hierarchy, you have to know whose eyes you're looking through. You're not looking through the controlling shareholder's eyes. So somebody please tell me, why on earth, with business combinations under common control, do we allow the book value method? Why? Whose eyes are you looking through? Okay, I just don't believe you if you can tell me you're looking through the non-controlling interest eyes and you're doing the book value method for business combinations. And if I was your regulator, I would be sitting at your desk asking you to explain to me how you have done that. But there's not a single regulator in the world that's asking that question. And I don't really understand why. Okay, because everybody just says, but in US GAAP, they can do this, so we can do it. No, that's not what IFRS says. It says you can look to US GAAP or similar, okay, if you don't, but you can't take the accounting if it's different from the conceptual framework, basically. So there's some words that people just black out when they read the IAS8 hierarchy. Okay, so it's common practice in the world, but I don't understand why it's allowed. Okay. Everyone happy on this one? Okay, so all of these things, okay, at the highest level, yes, it's the same. Okay, but in the detail, oh, it's slightly different, isn't it? It's always slightly different in the detail. Okay. Okay, so the next one is the materiality concept the same. So is materiality the same? 1.5 mark question, not 4.5 mark question. No, IFRS Sustainability Disclosure Standards, not ESRS, IFRS Sustainability Disclosure Standards and IFRS financial statements. No double materiality. It's all financial materiality. So 1.5 marks, it's exactly the same. Okay, in the detail, is it exactly the same? No, in the detail, it's written slightly differently. So it even says it's the same. But when you look at IFRS, it could reasonably be expected to affect a user's decisions. Okay, the information's there to help you forecast future cash flows. It's just inputs for you to do that. Okay, but then in the sustainability standards, it gets a whole lot more granular. It says, okay, it's material if it would affect cash flows short, medium, long term. Oh, in the IFRS accounting standards, we just said cash flows. Well, all future cash flows could be short, medium, or long. So that's not necessarily different. But then in the sustainability standard, it says could affect cost of capital, could affect access to capital. That could make it material. Aren't those just future cash flows? So to me, it's the same thing, but the words that are used are different. Okay, why are different words used to say the same thing? Why? Okay, it makes you think it might be different in some way. Okay, but it's the same concept, it's expressed slightly differently. Okay, so it's interesting. Well, 1.5 marks, it's exactly the same. And I haven't put in the detail, it's worded slightly different. Okay, but is it exactly the same? Okay, it's more or less the same. Okay, it's the same idea. Okay, so muster reporting entities, financial statements, and its sustainability disclosures cover the same reporting period. Okay, so if you've got annual financial statements, do you expect annual sustainability report ending on the same day? At 1.5 mark question? Yes. Okay, 4.5 mark question? Not necessarily. Okay, so in the detail, there'll be some small differences. Okay, does anybody know any of the small differences? Like your sustainability reporting when you're doing, so think you're going to have to do this in the not too distant future, wherever you are in the world. Okay, you'll have to look at your value chain's greenhouse gas emissions as part of your sustainability reporting. They could have a different year end to you. Okay, so now you have to work out what's my share of their emissions, okay, for scope 3 reporting for sustainability. And the information they publish when you look at it isn't the same year end as your year end. Okay, so you're obviously going to need some exceptions, aren't you? So in the sustainability reporting for that type of thing, you will get some exceptions. Okay, so it's ideally the same. Okay, but then for some of the reporting in sustainability in particular, you won't be able to get coterminous data. Okay, then you can use the best data you can find. And sustainability reporting is using bad data a lot because good data doesn't exist. So a lot of the time you're using fairly weak data to do it. Okay, so you can see some in the detail, at a high level, yes, but in the detail, maybe a little bit different. Okay, so must a reporting entity's financial statements and its sustainability report be disclosed, published at the same time? The same day, you must make both publicly available. 1.5 mark question? Yes. 4.5 mark question? There's some exceptions. Okay, so particularly transitional provisions, the first time you're doing sustainability reporting, okay, you're given some extra time to be able to do it, basically. And the amount of time, why they make this so complicated, the amount of extra time you're given depends on the interim reporting that you do. And if you do no interim reporting, then it's another date. So it is just all a little bit complicated, more complicated than it needs to be. Okay, so must a reporting entity's financial statements and its sustainability disclosures be prepared using the same data, the same assumptions, the same units of measure? Yes or no? 1.5 mark question. 1.5 mark question? Yes. 12 mark question? Okay, where you can, yes, but there's lots of places you have to do something different in your sustainability reporting. Okay, does that make sense to everybody? So to the extent possible, that's what practicable means. Okay, but there's lots of exceptions in the sustainability. Okay, so whose eyes must management look through when making relevance judgments? Okay, so sometimes you have to make a relevance judgment. Is the cost model more relevant than the revaluation model if you want to change from one to the other? Okay, so when making relevance judgments, which you have to make quite a lot of in IFRS, okay, so whose eyes must management look through? And this is when you're doing IFRS financial statements. Whose eyes are you looking through? Whose perspective are you doing that evaluation from? Okay, let's run this one as a poll. Okay, so 6 alternatives. Okay, in the Zoom room, we're getting a lot of different eyes. Okay, so it means some people aren't making the right relevance judgment. If you're looking through the wrong eyes, you're not going to make the right relevance judgment. Okay, so you've got to be looking through the right eyes. Okay. Okay, so it's a little bit mixed in the Zoom room. Okay, in this room, who says you're looking through management's eyes? Who says you're looking through, let's say, investors and lenders' eyes? Okay, so relevance judgments are materiality judgments are an example of relevance judgments. So who is it more relevant, you know, whose perspective is relevance judged from? Whose perspective is materiality judged from? Okay, investors, lenders, and other creditors. Okay, so there are other judgments we look through other eyes, but for relevance judgments, for materiality judgments, we are looking through the eyes of investors, lenders. Is it relevant to them? Basically, that's the assessment. Could it affect their decisions? Okay, so that's why it's that perspective. Okay, so I think that's an important one to clarify. Okay, if we can just turn them off. Okay, so next one. If we are looking at sustainability reports, so climate-related financial disclosures, and we're making relevance judgments, whose eyes are we looking through? The same eyes, aren't we? Okay, it's relevance judgment, it's the same eyes, so you're still on those eyes. Okay, whose eyes must the regulator look through when they are assessing the relevance judgments management made in preparing financial statements? The same eyes. Okay, the regulator regulates that management has done their job properly. If management had to look through investors and lenders' eyes, then the regulator must be checking that management looked through investors and lenders' eyes. So that's not going to change. And the same for the sustainability reporting, the climate reporting. Okay, so this example here, okay, this is how this airline says they're going to get to net zero. So here they've made their promise. Okay, so we way back here somewhere, they've made a promise that by this date, they're going to get to net zero, 2050. Okay, and they're telling us our strategy to get to net zero involves 4 main streams of things. The blue at the top, we're going to replace aeroplanes with more efficient aeroplanes, less polluting aeroplanes. The green in the middle, okay, we're going to use different fuel. We're going to use sustainable aviation fuel. We're not going to use fossil fuel. Okay. And then the next bit, I'm just trying to remember what that was. Okay, the next bit is going to be offsets. Okay, and the dark bit is going to be some kind of offset, and the lighter bit is going to be carbon removals. They're going to capture carbon. Okay, so the technology doesn't exist yet to do this, but this is their plan. Okay, this is what they're telling us they're going to do. Okay. Okay, so they've set out their plan for how they're going to get, and they've drawn a nice picture. I think it's quite easy to understand from their picture what their plan is. Okay, and many airlines like that big green area, and the world is saying to them, hold on, but if all airlines use the big green area, we're going to have whole countries planted under the plants that are needed to make the fuel. Are you sure this is achievable? So then an airline like this one says, well, I can't speak for other airlines, but I'm setting up factories to do this. Okay, I'm investing in the technology to do the carbon capture. So for me, I'm fine. I don't know about everybody else. Okay, go ask them. Okay, I'm entering into contracts to buy that fuel now. I'm even paying for the factory to be built to make that fuel. Okay, so this airline is trying to give you a convincing picture that they are going to get there using this. Okay. That's not to say there aren't other problems. There aren't other. So sustainability reporting is not just about climate. If we start cutting down the forest, okay, to plant maize, to make maize into fuel, okay, there are a few other sustainability issues, aren't there? But the big thing for the airlines at the minute is climate. Okay, so we all like to get on an airplane. Okay, it's not a good story when you get on the airplane for the climate. That's kind of the problem. So if this industry wants to persist, it's going to have to do some changes. Okay. So here they set out in some detail. So this shading relates to the shading on this slide here. Okay, so it's the same shading that we're having a look at. Okay, so when you're looking at the blue bits, they're explaining about the new aircraft and operations. So, you know, they're looking at hydrogen aircraft manufacture. They're looking at new fuel management software. They're looking at more efficient flight planning services. Okay, and they're looking at fuel efficiency software. So those are the kind of things. Their delivery plans, looking in the middle column. Okay, so they have got 13.5 billion investment they're going to be making between 2023 and 2030, and that is to get 192 new aircraft to replace old aircraft. Okay, and these are more fuel efficient. Okay, so you can see there are a number of things. They're buying new, more fuel efficient aircraft, and then they're investing in some technologies and things that are going to help them do better. For the sustainable aviation fuel, okay, they have, 865 million commitment, okay, to take sustainable aviation fuel in agreements that they have, but it's all based on assumed energy prices. So there must be some variable price element in what they are doing. Okay, and they're actually financing the setup or involved in the setup of LanzaJet, the sustainable fuel producer. Okay, so that's the way that they're going to try and make sure they get access to the sustainable aviation fuel, because all airlines are going to run for this at the same time. So you can imagine what's going to happen to prices here. So they're trying to lock some of it in for themselves, I think. And then carbon removals. So they investing in a carbon removals capture startup. So they're developing how to try and capture carbon. Okay, I hope this idea works. Okay, we've got a lot of trouble if we don't get this right. So somehow we're not going to stop polluting, it doesn't seem. So somehow we have to work out how to capture carbon and put it underground at a very cheap rate. Okay, so there's a whole lot of companies working on how to do that. Okay, and some progress has been made. So this company says to make sure we, in the front line on that, we're investing in some carbon capture and development technology. Okay, so there's a startup that thinks they can do this. We're backing them. Okay. And then I don't know what refining the IAG carbon removals roadmap means. That sounds like, you know, hot air to me. Okay, but okay, they're trying to say they're doing something in terms of delivery plans. Okay, and then when you're looking at offsets, okay, there is this airline scheme. I think it's the European scheme, Corsia. Okay, so they are involved obviously there, and they're going to do voluntary offsets for customers. So you probably see this when you buy your air ticket. Okay, you can offset your carbon if you want, and look at the price you offset your carbon at, and you think, I wonder if I'm offsetting my carbon. Okay, because the price is very low to offset your carbon. So I think, I wonder if there's phony scheme going here. All I'm doing is paying extra money. Okay, but some of the development aid projects I work on, they make me offset my carbon when I fly. And I just feel that I'm just throwing good money away when I do that. I mean, maybe there is somebody who can capture carbon so cheaply, but I'm not sure I believe it. Okay, so anyway, so they also helping set up some platform that will enable this to be done properly. And then, of course, like everybody big, they're going to get to their supply chain and start making their supply chain be more environmentally friendly. So, you know, you can see 74% of their suppliers have got scorecards on ESG performance. So if you're a small company somewhere far away supplying big company, you're going to be roped into this as well, because big companies are not going to buy from you, because they're all battling to reduce their emissions, unless they can say, you in my supply chain and you low emitter. Okay, so even if you're a small company, don't think this isn't coming my way. This is coming your way in the way people won't buy from you unless you have done something to show that you are low emitting. Okay. And then they're going to get new supplier contract clauses on sustainability. So they won't contract with you unless you are sustainable. So the most sustainable, the people that can advertise themselves as being more sustainable are going to get contracts, and the people who can't are not going to get contracts. Okay, so you can see this is an airline. This industry is under a lot of pressure over climate, and look at their plans. Their plans are coming for you too. Okay, whatever you're doing, you can be auditing and they'll be coming for you. You see the big audit firms in the UK already are saying, okay, we're not forcing you not to fly business class anymore, but we're encouraging you not to fly business class. Okay, encourage is step one. Step two is forcing you. Okay, so why? Because business class has 10 times the emission or something of economy class. So in the old days, if you were with big audit firm, you had to be in business class so everybody could see you were big and important and worth the money you paid. Okay, now it's going to be you have to be in economy class, because if they see you in business class, they're going to say you're wasting carbon. Okay, so the world changes. Okay, and this is some of the change that we see. Okay, so that's the background to, at a very high level. I had to summarize and this is just cut and paste, by the way, from their sustainability report. Okay, so I think this diagram sets out quite well, okay, what their plan is anyway. This is their strategy. Okay, so the questions we're going to ask are, sorry, I think we've gone out of line here somehow. Okay, so yeah, so on the basis of what you've just seen, okay, which assets and liabilities do you think are going to be affected in their financial statements? So when you read their sustainability report, okay, what assets and liabilities do you think are going to be affected in their financial statements? So that diagram, you looked at it, and now you think, so when I look at their financial statements, what am I expecting to see? Okay, are you expecting to see anything on property, plant, and equipment? Yeah, they're replacing aeroplanes. They have contracts to buy new aeroplanes. So there could be commitments. All their depreciation estimates might be changing. Remember, they scrapped all their 747s because they're polluting. Okay, so you see this happening. Okay, you see the estimates changing. Yeah. So an interesting one is residual value. How do we measure residual value? And I never see this discussed properly. So how do we measure residual value under IFRS? Is it that future cash flow that we discount, or is it how much would we get today if the airplane was already that old and in the condition we expect it to be in? That's how it's defined in IFRS, isn't it? So now you change. You say, instead of replacing my airplane in 10 years' time, I'm going to replace my airplane in 2 years' time. Okay, what's going to happen to residual value? Okay, so I'm replacing it because it's becoming worthless because nobody wants the polluting airplane. So the secondhand value of the airplanes is falling. But is residual value going to go up or down? Residual value is probably going to go up, isn't it? Because it's not that cash flow that I'm discounting back. It's asking today, not in 2 years' time, people would have changed their minds much more. Okay, it's measured today. So this is one of the times where I think the IASB has made a shortcut to help you see what residual value is, or make it easier for you to measure residual value. But now it's not going to work so well with the economics of climate change, because in climate change, it's actually going to have the opposite effect. If you were forecasting cash flows, you would probably come up with a lower number than you are by today, how much, because the trend is going in that direction. Okay, so if it was already that old and in that condition, how much would it sell for today compared to, well, in 2 years' time, when it actually is in that condition, it's likely to be a lower number, isn't it? Okay, so we're going to overstate residual value because of the practical expedient in IFRS, I think. Okay, but I don't hear a lot of people discussing this, but I think, yes, that's probably true. Okay, interesting. Okay, IAS 19. What effects on IAS 19 are you expecting to see? Have you seen companies yet that will, look at directors' remuneration, look at their incentives, And do their incentives have climate factors built into the incentives? Yeah, you see that now. This company has it. Okay, so the bonus you're going to get, okay, is based on meeting climate targets. Not all of it, okay, but at least some factors in your bonus is determined by meeting climate targets. And this is happening in many companies. Okay, so Daryl and I were analyzing some South African companies we're doing a project in Rwanda. And in those South African companies, you see climate targets. In Barclays Bank in the UK, you see climate targets in the bonus that the directors get. If they don't meet those targets, they don't get part of their bonus. Okay, so increasingly, you're seeing climate come up in remuneration, particularly higher level people who have some ability to influence where it goes. Okay, IAS 20, are you expecting anything? Was there any government grant here? Okay, so when you go back here and you look at some of the information, carbon offsets, an airline in the European Union, okay, there's government grant, isn't there? Okay, so there's going to be some IAS 20, and there's probably more coming, okay, because when we suddenly work out that our airlines have a problem, typically the government give grants to try and, I mean, think of the Biden administration, how much money it's given away to try and get people to be more climate friendly. That's all government grants. There's government grants all over, much more than there used to be a decade ago, not just because of COVID, but because of climate too. Yet we don't want to fix government grant accounting. Why is that? Do we not want to see in financial statements how much gain people are getting from governments? So we complain, oh, something's cheap from your country because your government has subsidized but then we don't want proper transparent accounting of government grants. Why? I mean, wouldn't we see it if they had to do transparent government grant accounting? So why are we speaking with a forked tongue all the time? Okay, because that's what it sounds like to me. Okay. Okay, and IAS 36, impairment of assets. Yeah, it could well be coming up. Okay, so that's likely to happen. IAS 37, provisions. Okay, so we committed to doing something long time in the future. Okay, 2050. Okay, so nothing for that. Okay, but we do have to pay for pollution right now under the EU ETS scheme. Okay, so as far as we have polluted and have to pay, yes, there's going to be something under IAS 37. Okay, IAS 38, intangible assets. Your emission trading certificate, what is it? An intangible asset? Okay, so definitely. Okay, there could be impairment of your all sorts of brands, things as well. Okay, IFRS 5, we committed to sell anything? Yes, probably. The old planes, we committed to sell at some point, so you would expect something there. So it's affecting everything. Okay, so even though we're not at 2050, we're a long way from 2050. We've got a plan to get to 2050. Already that plan is coming up in our financial statements in many ways. Okay, does that make sense to you? Interesting, isn't it? Counting is such fun. If only we told all of the truth all of the time, it would be more fun. Okay, so this was just running through, and we've discussed this briefly as we've gone through. We discussed you would expect it to affect property, plant, and equipment, especially depreciation. It could be impairment. There could be non-current assets held for sale. And in the detail, if you read that whole big case study, you could see that they've removed 12 aircraft from service. Some they're looking at putting back in service. So things that were non-current assets held for sale, they've changed their minds. So some of them are coming out of that category. Okay, so it is quite interesting, some of the things, impairments, reversal of impairments. We didn't discuss research, but remember some of the promises they made was investing in research to capture carbon and so on. So you would expect there's some research and development expenditure. When the development's complete, we'd expect amortization of that. And there'll be lots of impairment testing because lots of people are trying to do the same thing. And you know, there's going to be a lot of write-off of stuff that didn't work out the way we expected it to. Okay, and then looking at intangible assets, we discussed the emission certificates, employee benefits, the incentive schemes, and in IAG, you can see it in the annual incentives and you can see it in the long-term incentives. Okay, so it's affecting those. There's a possibility, which we didn't discuss, of onerous contracts. Okay, so you've entered into contracts that are executory contracts for the purchase or sale of a non-financial item that through climate problems become onerous. Okay, and some of these contracts are long-term. Okay, so that might be coming out. Okay, you've got obligations to surrender the certificates. We discussed that. Okay, and then there could be some others coming out of your constructive obligation if they have met that threshold, as we discussed. Okay, so those are some of the things you might see. Okay, so the next thing, do you think there are any unrecognized contractual commitments? So things that aren't in the balance sheet. So do you think we have contractual commitments that we might write a story about or not write a story about? Because IFRS is weird. Some contractual commitments you have to disclose. Other contractual commitments you don't have to disclose under the specific requirements that say, you know, the company shall disclose. So if it's property, plant, and equipment or intangible assets that you're buying, you shall disclose. But if it's anything else, there's no you shall disclose. Okay, so if you've got jet fuel futures, you know, that aren't derivatives, it's a contract to buy jet fuel at a fixed price in the future. The deliverable is jet fuel. There's no requirement to disclose that unless it becomes an onerous contract. Isn't that weird? I mean, about a third of the cost of an airline's operation is fuel. If they've entered into contracts to buy fuel forward, I would argue, if I was your regulator, there's an overarching disclosure requirement and you disclose it. Okay, but when you read the shall disclose, there's nothing saying you shall disclose that. Okay, only if it becomes onerous, then you tell people about how onerous it's become. So basically, if using that fuel, your profit margin on flying is going from 20% to 1%, you don't have to tell anybody unless the overarching disclosure kicks in. But your profit margin, usually 20, goes to -1. You must tell people about the -1, not the 20, the -1 only. That's the onerousness of the contract. That's a little bit weird. Okay, so I think we've discussed everything that's on that slide along the way. So I don't think we have to go through that with you. Okay. And we did know that there were executory contracts, by the way, because remember the alternate aviation fuel, they had contracts. They told us nearly $1 billion in contracts going forward. So they clearly were there in the information that we've seen. And there's some other, like Aer Lingus, the Irish airline, has got some other commitments and so on. Okay, so you can see that that exists. Okay, we've discussed that one. We've discussed overarching disclosures. Okay. Okay, so on the basis of their climate disclosures, what aspects of their consolidated financial statements do you expect would be materially impacted by climate matters? So which ones do you think you're going to have to make those disclosures about judgments that did not affect measurement? So not key measurement assumptions. Okay, we're going to do those separately. But things that don't involve estimation uncertainty, that are some of the biggest judgments that this company had to make. So these, remember I said those most important disclosures, the ones that are judgments not involving measurement, and the ones that are judgments that involve estimation uncertainty. So we're not looking at the estimation uncertainty now. Okay, we're just looking at those that are we are looking first at the key sources of estimation uncertainty. Okay. Okay, so aircraft depreciation for this company, that could be one of the biggest estimates that they have to make. Okay, because it really makes a difference to their financial statements. It's about a third of the cost of flying an airplane, depreciation of the airplane. A third's fuel, a third's depreciation, and a third's everything else. Okay, so their estimates around depreciation could be a key source of estimation uncertainty. Okay, I've got the wrong paragraphs there, I'm embarrassed to say. It should be 125 to 129. Okay. Okay, so impairment of assets, that could be coming up. Fair value measurement. Okay, so we haven't really discussed their pension plans. Okay, but they've got defined benefit pension plans, so measuring the fair value of the assets in the plan. And I think the projected unit credit method also to measure the liability, the promise under the plan. Okay, so I think both of those could come into this category. Okay. Changes in accounting estimates, would you expect to see any? Yes, from what we've discussed. So climate is changing. Okay, so we'd expect these estimates to be changing. Almost anything that's an important estimate, we would expect to be changing. Okay, so I think that makes sense. Similar things we've looked at so far. Okay, now I've got the right paragraph numbers. So judgments that don't involve estimation uncertainty that are very significant to this company. Anything you can think of? So we've dealt with all the estimation uncertainty, where you'd be doing sensitivity analysis, and the sensitivity analysis would be done on the reasonable possible change in the assumption. Okay, so now it's not those ones, it's the other ones. So the ones that don't involve estimation uncertainty. Okay, so this was covered partly the pandemic period, which we didn't mention, but obviously there could be going concern issues. I think airlines, because of climate, could face going concern issues in the future if they haven't sorted themselves out in some way, found a better way of doing it. Okay, so tax loss, because we were in a pandemic, so these companies made huge losses. Remember, we discussed yesterday the judgments in that, so that could be coming through. Reasonably certain, it's an airline, it's going to have lease renewal options to keep airplanes off balance sheet. Okay, so remember our reasonably certain recognition threshold. So that's going to be relevant here. Okay, is it a provision? Is it a contingent liability? Sometimes that line. Okay, and then the executory contracts, are they in the scope of IFRS 9 or are they executory contracts? Okay, so those are some of the things that we might expect to see there. Okay. So is the reporting entity the same? Okay, we've discussed that already. Okay. They used TCFD. So TCFD is what the Financial Stability Board produced, which they've now given to the IFRS Foundation, which is basically built into what IFRS S2 is now. Okay, climate-related disclosures under IFRS standards, the foundation of that is TCFD. So when we're illustrating the sustainability reporting, we're trying to find better practice examples. There's no IFRS sustainability reporting yet because nobody's reported under it yet. We go find good TCFD because TCFD is now part of, it's the foundation. It's been built into IFRS S2, and then some more things have been added in IFRS S2. Okay, so it does have the same focus. Okay. Okay, so should it identify, so this question was, should it identify the financial statements? There actually wasn't a requirement in TCFD to identify the related financial statements. There is a requirement now in the, so this is one of the things that's been added when you get to IFRS S2. Okay. So and you wouldn't know this, but IAG was using TCFD. They're also using some GRI. They're also using some SASB standards. They're also using, so unless you read that whole case study, okay, they're using a fruit salad of different requirements. Okay, so going forward next year, they'll be using ESRS. They will, you know, that's what they will have to be doing. Okay, but at this point in time, that wasn't the case. Okay, so at that point in time, okay, they weren't focused on the same user needs. If they move to IFRS, instead of going to ESRS, okay, then they would be focused on the same user needs. Okay, but ESRS has got wider, it's double materiality, so it's different, it's a report to society. Okay, so they're not, at the minute, they're a mixture of things, some of it double materiality, some of it single materiality. Okay, so I think basically we've gone through probably enough. I'm getting some I'm looking tired and ready for lunch looks. Okay, so and this is now getting a bit superfluous to where you are right now. This is more things that are coming soon to you when we're looking at the sustainability reporting aspects. Is the best business in the world, okay, and the best accounting in the world, because we do fair value accounting. Of course, farmers are going to do the good accounting. Okay, but then it does get a little bit difficult sometimes because we actually have to measure fair value. Okay, and measuring fair value can be a little bit difficult. Okay, but at least we know what we're trying to measure. We're trying to measure what the asset would sell at in a market when it's well advertised, all the buyers and sellers know, identify the market participant and so on. Okay, but this question is specifically related to plants. So it's plants that you are measuring the fair value of. Okay, so not all plants are you measuring the fair value of. Remember, bearer plants have gone to property, plant, and equipment. You might be using revaluation model there. And if you are using revaluation model, you would still be measuring fair value. There could be a business combination. You'd still be measuring fair value. Okay, but if you are looking at plants that are within the scope of IAS 41, still could be walnut trees. I think in this part of the world, you have walnut trees. So where the wood is valuable after you have finished harvesting nuts for many years. Okay, so for those trees that you're measuring fair value of, which are typically the kind of walnut type trees, or the trees that the wood is valuable in after, you have to, you know, like I said when I discussed fair value measurement the other day, you use whatever information is available to you at that point in time to measure fair value. Okay, so if you've got trees that are planted in land, you haven't got the tree trading in a market. Okay, so you're trying to work out the fair value of a tree which is planted in land. So one way you can do this, if the information's available to you, is you can look at sales of land and trees near you where the land and trees is in similar condition to your land and trees. And then there might be vacant land that is similar to your land, except it doesn't have trees planted in it. And then deduct the fair value of the land from the fair value of the land and trees together. And that will give you the fair value of the trees. Just remember, you have to adjust for everything that is different from your reference price to the asset that you are having a look at. Oftentimes, you won't be able to find sales of similar things, so you won't be able to use that method. So then you're typically discounting cash flows. Okay, so remember, you're discounting market participant cash flows on those trees and the land because you need the land to get the trees. Okay, so if you do it as a combination, land and trees together with cash flows, then remember you've got to take the land out so you're left with the trees. Okay, so I've seen this done quite a few different ways. If the trees are very young, another way that you sometimes see it done is just by, well, what did it cost me to plant the trees? And you allowed, if you think that's an approximation, to use that in that case as well. Okay, but it depends very much on the information that you have at a point in time. Okay, so one of the companies that I follow who does measure the fair value of these things, they are largely discounting future cash flows to work out the value of the trees. That is largely how it is done. Okay, but remember, you know, there's land, so you need to charge. If you're discounting cash flows on the trees, you need to discount, you know, a notional charge for the market rental of the land. Okay, and regulators are regulating this. So in the UK, there was a company actually that measured the fair value of its trees by discounting cash flows and deducted just a low rental, like a historical rental for the use of the land. You can't do that. It must be an up-to-date market notional cash flow that you deduct from your cash flows when you're working out fair value. Okay, so you can't have the tree without the land. So you need to charge an up-to-date market rental of the land when you're working out the cash flows from the trees, if the cash flow is coming from selling the tree, if you understand what I'm saying. Okay, so it depends what information you've got available to you. You could have recent sales of similar land and trees, and then you can get a reference price from that. Then you need to just separate the land out so you're left with the trees. If you haven't got recent transactions price of similar assets, okay, then you're discounting cash flows. Okay, so you probably a level 3 fair value measurement, and you are probably discounting cash flows. Okay, that's probably what you're doing. Just remember as well, if it is a fruit tree that you've got, that you're measuring the fair value of the tree, the fruit on the tree has to be dealt with separately from the tree and separately from the land as well. Okay, so there's that complication as well. Yes?
The biological assets is marijuana. Marijuana, it's plant. The biological assets.
Yes.
Cannabis.
Oh, cannabis, that's fine. It's no more difficult to measure the fair value of cannabis than it is to measure the fair value of anything else. Okay, so it's just I don't know much about cannabis. I'm that boring. So I don't know if it's an annual plant or if it I don't really know about the accounting for cannabis. But when you have to measure the fair value of something, it is not it's not particularly difficult to do that.
I'd probably say that the fair value of cannabis and possibly some other products benefits from a very active market in which the price determination happens on an ongoing basis.
Yeah.
So you probably have better price discovery for cannabis than
you might well, actually. And is cannabis a plant that you plant the seed, the plant grows, you harvest it, and then there's nothing left over? Okay, so then you have to be doing fair value accounting for it whilst it's growing. Okay, but as Daryl's saying, you're probably getting a good indication from the market that you are selling into, which is probably your principal market, what the likely cash flow is from the harvest you're going to get. So you can work backwards from there. Okay, so you probably have got reasonable price points to use to work back from in that case. I think more of the longer life plant becomes more difficult. The shorter life plant like that becomes relatively easy. Over to you, Daryl, for the next one.
Thank you. And I should have explained this from the very first. My wife always says that in order for me to... Yes. Okay. In order for me to activate my mouth, I first have to activate my feet. So I can't sit and talk. I need to stand and talk. So let's see what the question coming in is from...
The question from yesterday.
Okay.
Okay, well, shall I deal with that one first?
Absolutely.
Okay, so we did an example yesterday where the JSE, the Johannesburg Stock Exchange regulator, had regulated a company. And remember, it was a group. You had the parent, subsidiary A, subsidiary B, and subsidiary A was renting a building to subsidiary B. Okay, so in that case, in subsidiary A's own financial statements, it had an investment property, and it was using the fair value model for that investment property. So in subsidiary A's own financial statements, it was accounting correctly, as far as we can tell, okay, for an investment property at fair value as an investment property. But it's renting it to subsidiary B. So when we consolidate in our consolidated accounts, we are occupying our own property. So now it's owner-occupied property. It's not investment property. Okay, so from the group perspective, it's property, plant, and equipment. But what happened in that case when it was being consolidated, they were just adding the subsidiaries' numbers to the other subsidiaries' numbers to the parents' numbers. Okay, and they had ended up still having the fair value adjustment, the change in fair value in the consolidated accounts. Okay, and in the consolidated accounts for owner-occupied property, plant, and equipment, the model that the group was using was the cost model. So they need to reverse out. The regulation was you're not doing this properly. You need to reverse out all the fair value accounting, and you need to do the accounting under the cost model. Bring in the depreciation. Okay, no fair value measurement because you're using the cost model. So it was undo all the accounting that the subsidiary had done for fair value model and do the accounting that is necessary for property, plant, and equipment cost model. Okay, because the group is using a completely different accounting policy. Okay, and it's applying a completely different standard. The group must apply IAS 16 and the subsidiary was applying IAS 40. So undo all the IAS 40 accounting and do the IAS 16 accounting, property, plant, and equipment.
Yeah, then I'm also going to suggest
Yeah.
that while I answer the revenue question, you have a look. I don't think you answered the question that's on the screen, to be honest. I think it's a different question. All right, so the revenue question I've got is coming back to that apartment example that we discussed yesterday. And I think this is actually right. We've talked about this a couple of times. In practice, what the ISB has seen as one of the hardest areas to apply IFRS 15 is these contracts that relate to an apartment. So the question here is, okay, I've got an apartment. The apartment in this particular context, and this might still be the same one from Armenia. In this particular context, what's going to happen is the construction company is going to build the apartment block. It's going to build the apartment for an individual buyer. It's going to transfer, the buyer is going to take possession of the property, but it may take up to a year before title is actually transferred. So there's a long delay between completion, then possession, and then ultimately title. And the question is, do I have to wait all the way until title before I can actually recognize that I've made a sale? So I'm going to answer it in those three stages. So the first thing, as we said yesterday, if I meet the requirements for overtime, so in other words, I'm building a standardized process, and no matter what happens, the person who is buying the apartment from me has to give me money. They have to pay for it. Then it's very much like the audit fee example we spoke about on the first day. I will say, as I put each brick, each marble piece in, every other thing in, as I put them into that apartment, I am going to recognize the apartment as having been partially completed. I'm transferring it over time towards the customer. If I do not satisfy the requirements for overtime, now this means either I am building a standardized thing, which I have ability to, and the customer doesn't have to pay until it's finished, and there's a exit clause or something else. So in this situation, what I'm saying is the customer has no control. I, as the builder, have control over the property until I transfer it. Okay. And I can't oblige the customer to pay, and it's not a standardized product. It is a standardized product. In that case, what's going to happen is I'm going to delay until such time as from a what did I say? From a control perspective, from a principal perspective, I have transferred control to the customer. Now, I've got two measures here. On the day that I say to the customer, your property is finished, come and accept it, come and inspect it and accept it. And once you've accepted it, it is essentially yours, and the risk of ownership transfers to you. Then that is a point in time transfer, and I'd recognize it on that date. And if legal title is an administrative thing that takes a year, so be it. It takes a year, it's administrative. It doesn't matter, it doesn't influence the process. But, and this might be the question that's coming in, if it is a significant process. So let's assume, let's say, for example, the law in the country I live in says that you can go live in the apartment, it's fine, it's your apartment, you can go and move into it and everything, but the transfer cannot happen, title cannot happen until the construction company has completed a whole bunch of things. And let's assume some of those things are safety checks and some of those things are completion of the property and et cetera, et cetera. In other words, there are genuine suspensive conditions. And during that period, if something goes wrong, I give the money back to the person who bought the apartment and I have to go fix it. Then I have a situation in which I will only recognize the sale when title is issued. So what I'm looking for is I'm looking for the point at which I say I have genuinely transferred the responsibility for this apartment to the homeowner, to the person who bought it. And it is a matter now, unfortunately, of law. So I can't give you the absolute answer. It's going to depend on what the legal construct is. What I can say in most of the jurisdictions I've seen, and I think we had an example of Mauritius when we spoke about this the other day, in most of the examples I've seen, although title does not transfer until much later, the reality is at the point of possession, at the point of completion, it's very, very hard to argue that control is not transferred because the title is simply a matter of an administrative process that has to be completed. It's good that this question has been asked because this was way back when, even before IFRS 15, this was the subject of an interpretation, I think IFRS 18. So this was subject of an interpretation. Then that interpretation was sucked into the standard to deal within the standard. And then it's been subject to a couple of questions that have come to the interpretation committee since. So people are still struggling to get their heads around this one.
So just coming back to the agriculture one that you asked about with the fair value of the plants, just remember, if you are discounting cash flows, that you need to think of, if you're taking a price from a market there, your product isn't at the market, location is a characteristic of the asset, so there's transport costs. It's not mature. Okay, so if it's not mature right now and you're thinking of the cash flow you're going to get, then you have to think about, well, there could be possible droughts, all those other things that can happen that can affect. So there's a lot of adjustments you have to make. Okay, so even if it's mature and you're picking it tomorrow, it's not the price at the market. That's the reference price. You still have to adjust for everything that's different, including location. So, just think about all those things whilst you're doing that discounting. Okay, then the next question is to do with leasehold improvements. So this also came from yesterday morning, I think it was, when we did leases. So remember, we looked at a Johannesburg Stock Exchange regulation where there had been leasehold improvements, and the leasehold improvements were capitalized as an asset, and then the leasehold improvements were depreciated. Okay, so we expect that would be the case. And then remember, in that example too, there was a requirement in the lease that you remove the leasehold improvements at the end of the lease. So then we raised the liability. By putting it in, we've incurred the liability to take it out. So you raise the liability and you add the liability to, the asset as well. So you depreciate that as part of the asset that you're depreciating. And your liability obviously is only removed at the time you settle the liability. You clean it up, you take it out. Okay, so I hope that answers the question for you. So leasehold improvements would be capitalized as an asset, provided, there's economic benefit, which there probably would be. You wouldn't be doing them if there wasn't economic benefit. Okay, and then they are depreciated. Remember too, oftentimes with those kind of improvements, you have an obligation to remove them. You capitalize to the cost of the obligation to remove them, and all of that is depreciated. Yeah, so I hope that clarifies, and go look at that JSE regulation of it if you want to look at a real world example where a company wasn't doing that and then was regulated to do that.
All right, then open up to the floor and open up to people online. So this is your last chance because Mike's leaving in a few minutes. So it's the last chance to put him on the spot. Has anybody got any other questions on any of the topics we've covered this week? And I'd probably go further and say, have you got any other questions on anything related to IFRS accounting? This is your last chance to ask Mike a question.
And
Yes.
there's only one rule. If it's a difficult question, you ask Daryl, and if it's an easy question, you ask me.
Yes.
Thanks. I actually have two, if I may. They're sort of indirectly related to everything that we've discussed so far. So the first one is relates to our upcoming transition from one IFRS version to another. And it's quite a big leap from a version of 2010 to 2023. What would you say is the biggest challenge or the biggest risk for us as auditors, regulators, preparers of financial statements that we should be focusing on or looking at in the upcoming period? That's number one. And number two is sort of a thought-provoking question based on your past experience. We talked about sustainability reporting and how that connects to the current IFRS standards, but in terms of the future direction of accounting standards, what would you believe is the most significant areas where IFRS standards might go to next, in light of, I don't know, the current the new business realities such as digital assets, artificial intelligence, etc., or maybe some other area that I haven't mentioned?
Should I have the first go and you pick up from there? Okay, so I mean, I guess for me on the first one, and I've been part of this transition once before, many years ago when it happened the first time. The seriously biggest issue is trying to figure out your opening balances. A lot of the stuff, once you into it, is relatively easy to deal with. But IFRS always has as a basic starting point the inherent assumption that you should pretend like you've applied the standards forever. And pretending like you've applied the standards forever means you have to figure out what your opening balance will be for you in North Macedonia, what your opening balance will be on 1 January 2023. That is probably the 1 January 2024. That's the biggest challenge you're going to deal with, because you're having to rethink those opening balances, rethink those processes and the like. So that for me has always been the biggest one. And I think that's something you need to be thinking very hard about and working through the process and making sure you've got that. And the nice thing about it, there's no need to wait until next week, because we're talking about 1 January at the beginning of this year. You can go back to your office on Monday morning and start looking at that and thinking through the process. In terms of the actual application of the standards, and Mike might have touched on this a little bit, I think the biggest issue around IFRS accounting has always been the fact that you have to make judgments. So we tend to think about accountancy as, we tend to fall into the trap sometimes of thinking about accountancy as bookkeeping. But accountancy, when it comes to this, is not, and Mike just, in talking now specifically about biological, you say fair value, but then I've got to think about the judgments that go into fair value. And so for me, what you need to be doing in the context of the company or the company you're advising, the company you work for, working through and just understanding very early what are going to be your biggest points of judgment. You want to develop a methodology, you want to develop a process, you want to know when the time is to ask for help. And all of that can only come from you, because your company and your company and your company are all unique. So just identifying what those key points are of judgment. That's always been the biggest ones for me, and trying to get to those first, so that you're not trying to answer that question on 31 December 2025. You're answering the question now in the next couple of months. I don't know if you want to add anything on that one, on the first question.
I can take the second question.
Okay, go for it.
Okay, so on the second question, I think the biggest project going forward is intangible assets. So the way we account for intangible assets is not fit for purpose. So the ISB has said, okay, we have to do something about intangible assets. Getting agreement on what to do about intangible assets is going to be an interesting exercise. Okay, so I think there's going to be a big project on intangible assets, but I don't think the world's going to wait for the big project to finish. I wish they would, because I think you fix things properly rather than do a whole lot of random little things in the meantime. But you can see already from when we were doing climate, they're things people want done now, basically. So there's going to be a whole lot of little now things done. So the obvious one is cryptocurrencies. So people aren't, you put in cryptocurrencies in intangible assets, which is where they belong, but then having to do revaluation model instead of fair value model, when the US has just issued a standard saying you would do fair value, and they would do fair value irrespective of whether there's an active market, okay, because they just feel it's the right account. So for once, I agree with them. I think they're right. Okay, and then there are other things like emission trading schemes, where people are now beginning to say that mess we looked at earlier, that needs to be cleaned up. So rather than fixing the underlying standards, which is what they should be doing, I've got a feeling they're going to do a project on emission trading schemes. Okay, and so then we're going to end up with random solutions to different problems rather than trying to fix the underlying structure which is broken for intangible assets. Okay, maybe I'm wrong. Maybe everything will be consistent and nice. That's certainly what I'm going to fight for. But okay, I'm used to losing my battles, shall I say. So, and then just on a smaller project that I think the ISB has now indicated they're going to do is cash flow statements. So I think that probably, they've fixed quite a bit with cash flow statements lately. They've taken away the option to show some of the cash flows, a choice operating or financing when they're clearly financing. So, they've eliminated the operating alternative, and they've done a few other cleanups basically. So I think that's good. And then I think the regulation, like those regulatory examples we looked at on, when was it, on Wednesday, okay, with the cash flows being regulated better, so people understanding, cleaning up some of the bad practice rather than fixing the standard as well. But then I think particularly for financial institutions, there's still a problem with cash flows that needs to be fixed. So I think that is likely to be what the ISB is going to address in their cash flow project. Okay, so I think that's probably where I see the most interesting things happening in standard setting for accounting. Is there anything else you can think of that?
The only one I'd add to that, but I just want to re-emphasize, I think there's a theme that runs through this to some extent, and that's technology. So the whole technological cyberspace means we're suddenly dealing with things like cyber currencies we haven't thought about. The increased sophistication of markets means that we're seeing lots of things traded that weren't traded before. The measurement of intangibles was impossible at a point in time, but it's progressively becoming more possible. So I think with this underlying idea of trying to accommodate the changes in the world brought by technological revolutions and evolutions all over the place, the ISB is taking very seriously the intangibles project. And I think that's where a lot of these valuation things come to a single place. I agree with Mike. I would love for them to solve rate regulated and cyber and trading and crypto and all of these things. It would be awesome if they could solve it with intangibles. But as we talked about a little bit on Tuesday, the problem with intangibles is it's a very hard nut to crack. It's a very hard one to think about, and they're going to have to work through that. But hopefully they will do that. And then the additional thing that comes through in the technology space that I think we're seeing a lot of conversation about is, and again, we talked about this a little bit on Tuesday, very few people use financial statements the way Mike and I used to use them when we were sort of developing our knowledge in this space. Mostly it's electronic. And so the idea of electronic, thinking about it from an electronic space, thinking about the structure electronically is becoming much more of a driver. And I think the IASB and the ISSB are both seeing how you present technologically as a critical element to the way they portray their projects. And I think that's the other big change. But I agree with you on the cash flow thing. I think hopefully they will fix that. And that walks us quite nicely into the question that came through online. So the question online was, do we see greater coherence? And that's the word that the ISB uses, greater coherence between the cash flow statement and the new IFRS 18 income statement. So cash flow is always talked about investment and operating and financing, And now the income statement or the profit and loss statement talks about the same categories. I think unquestionably there is now more coherence. And Mike talked about the tightening up of the rules in cash flow side. Cash flow hasn't changed so much, it's just tightened up and taken away some of the choices. The income statement has been tightened up considerably by IFRS 18. And I think the answer there is it is much more coherent now, even though it was not the consequence of a project on cash flow statements. It was the other side trying to reflect the same. So the outcome there should be similar. So that answers that question as well. But I want to come back to you and just see if there was anything else you wanted to ask around that. Okay, thank you for that question. Anybody else? We're still in the last chance saloon here with Mike, so yes.
I would like to use this opportunity again, this time publicly, to ask about your view. As you know, in April, the Ministry of Finance published the translated version of IFRS effective date 1st of January 2023. And for accounting and financial reporting requirements for insurance contracts, it gave transitional period to be implemented, the effective date to be 1 January 2028. From the other side, it is not strictly in the rule book that determined the effective date. It's not strictly determined that until this date, the effective date of IFRS 17 requirement, that entities should apply the IFRS 4 requirements that were translated in 2009. And from the other hand, in other article of the rule book, it says that IFRS translated version in 2009 will be will cease to be valid, implemented from 1st of January 2025. And also with regard to all other requirements of the translated IFRS, it says the effective date will be 1st of January 2025. And here, immediately after the translation was published in the official journal in Macedonia, there were a lot of questions raised mainly by insurance companies, their accountants, financial managers, actuaries, asking for clarifications whether this means that IFRS 9 requirements will be from obliged insurance companies will be obliged to implement the effective date of IFRS 9 to be earlier than the effective date of IFRS 17, the first date of application. And the second, with regard to IFRS 4, that whether it is true that it will continue to be regulation and the requirement for accounting for insurance contracts, or what else? So,
let me answer on what I know, and what I know is obviously more generic than necessarily North Macedonia. So I'm talking about a bigger worldview. So I think the starting point would be, why did the ISB in the first instance decide that insurance companies would not have to implement IFRS 9 when everybody else did, and suggest that they should wait until later? And I think the rationale for the IFRS Foundation, or for the ISB doing that, was to say IFRS 9 is a very big change that affects one half of the balance sheet. IFRS 17 is a very big change that affects the other half of the balance sheet. There is some logic to saying that if the two of these move together, an insurance company would be able to think through the process of how their asset and liability interact. Alternatively, if you said if IFRS 9 went first and IFRS 17 went later, you would have changes to one half of the balance sheet, and then a delay of time, and then changes to the other half of the balance sheet. And from an IFRS Foundation perspective, the IFRS Foundation was comfortable, the ISB was comfortable to say that it makes sense for these two things to move together. That said, I think we must also remember that at that point in time, so this would have been about 2016, I think, in 2016, there was no experience applying IFRS 9. Nobody was doing it in the world. It wasn't adopted yet. It was a brand new standard. Now there is a lot of experience applying IFRS 9. People understand how IFRS 9 works. People understand the issues and the underlying things. So the difficulties that the ISB perceived in having to go IFRS 9 first, IFRS 17 later, a lot of those have gone, because for companies, insurance companies operating within Macedonia, you have the benefit as an insurance company of looking at what is happening in the environments around you. I think many of the insurance companies operating here have holding companies outside. You can see what decisions they made for IFRS 9, what decisions they made for IFRS 17. So I think the original rationale that the ISB used to keep these two together still has some validity, but it is a lot less valid than it was when the ISB made that decision, because there's just so much more information available for companies to take on. I'll also say, having gone through the process as a director of an insurance company when the insurance company adopted both IFRS 9 and IFRS 17, in hindsight, as a director, we would have said it was better to split them. It was just so much work to do virtually every asset and liability on your balance sheet at the same time. So putting aside whatever the law might say, there's also the argument for what you want to do as an insurance company if you're an insurance company within the jurisdiction. On the question of old IFRS 4, new IFRS 4, IFRS 17, I think unfortunately almost the timing that North Macedonia, the timing of the change in North Macedonia creates a complication for insurers. Because what you've done is you've adopted 2023 IFRS, which has IFRS 17 in it. Okay. That means IFRS 4 is gone. It's disappeared. It's off the table. Your IFRS now has IFRS 17 in. Then you've got an extension date on IFRS 17 that says you can delay applying it. But now what do you apply in between? The truth is that IFRS 4 has been updated a number of times over the last years. 2016 was one. There were a number of other updates in process. So putting aside things like translations and all that sort of stuff, in a perfect world, if you are delaying IFRS 17, my recommendation would have been to say it's good to apply the latest version of IFRS 4. It links to IFRS 16 and it links to IFRS 15 and it links to IFRS 9. So it actually is a standard that is coherent within the bigger body of standards that you're adopting. But I'm not going to make a promise on behalf of North Macedonia, because that implies potentially translation hurdles and other things. And you would have to weigh up the cost and benefit of those two. But that would be my starting point. It's not the perfect answer, because I think you have to think through it. The one other thing I would just say, in the context of my understanding of the insurance industry in country, it seems to me that there are going to be a number of companies that are already doing some form of IFRS 17 reporting, just because of their holding companies and the like. And it seems to me like the best answer, without knowing what the legislative landscape looks like, is to allow early adoption. And that just permits those companies to have the ability to prepare only one set of accounts rather than two. And again, that's my opinion that I'm kind of throwing in the air. Okay, for sure. Any other questions? Going, gone. There goes Mike out the room. Oh, sorry, this is not the right presentation. So this is the day, thank you, Mike. This is the day 3 presentation. There you go. I'm glad Mike was paying attention there. Now I'm just wondering if I sent you the right one. Okay, so just open that. Okay, and just do me a favor, go down 2 pages. I just want to have a quick look. Maybe I've just got the title wrong. Down, keep going. Ah, No, this is the right slide, it's just the wrong title. Sorry about that, thank you. Okay, so Mike picked up a distinction here in terms of what it said on the screen. We were panicking a little bit that we had the wrong presentation, but all we've got is the wrong title page. Okay, this afternoon's discussion is going to be around quite a big topic, and it comes back very much to your question, I think, which is the adoption of IFRS 9. So IFRS 9 is the financial instrument standard. It deals specifically with financial instruments unless they are scoped in somewhere else. Importantly, a lot of people look at IFRS 9 and they say that's the standard for insurance companies and banks. Okay. The answer here, insurance company and banks have the most financial instruments, but every single one of you in the room has financial instruments. And so it's really important that this applies to you. What I've tried to do in terms of the pack, you'll see if you've received the pack already, the pack is about 160 pages long. Okay, the good news is we are not going to try to get through 160 pages before the weekend. What I'm going to do with the presentation is I'm going to focus in or drill down on IFRS 9 more generally. So I'm not going to go into some of the detailed bank examples and the like. I think the good news in North Macedonia is that your banks have been applying IFRS 9 for a while. You're familiar with the issues. I've had some great conversations with your central bank, and there's a really good understanding in North Macedonia for the banks. So we'll spend some time on the non-banks and how this impacts you as a non-bank. The insurance companies will have a lot of learning to do, as we've mentioned. But the examples and things I'm going to give you are hopefully much more relevant for the more general run of companies. So the starting point that I wanted to get into is just to talk about which standards we are actually referring to. So we always fall into the trap of IFRS 9, but there's actually a body of standards that deal with financial instruments. IFRS 9 is the obvious one, and it deals with recognition and measurement of financial instruments. It is still supplemented a little bit by IS 39, but the stuff that is left behind in IS 39 is really 100% only for banks. It is about a concept called macro hedging. It is how you hedge the entirety of your assets and liabilities space. On the IFRS 17 question, some insurance companies might also be using this, but it really is if you've got a very big macro level hedging relationship that you're dealing with. So for the focus here, we're focusing on IFRS 9. And then what happens is IFRS 7 talks about the disclosures you have to do on financial instruments. So the information that you have to provide. I got a question at the tea break on Tuesday, I think. IFRS 7 defines all of the disclosures. One of the disclosures it requires is that you must disclose the fair value of a financial instrument, even if you carry it at amortized cost. So if you don't understand fair value of financial instruments, now we're getting to a good time to get an understanding of it. But the fair value of financial instruments is exactly the same as Mike described the fair value of biological assets. What are my expected future cash flows? How do I discount those cash flows back to today? Do I need to adjust for risk? If I'm thinking about the fair value of, let's say, a bond, and the bond is untraded in North Macedonia, I would look at what I expect the cash flows to be from that bond. I would look at other bonds that are traded in Macedonia and see what the interest rate profile looks like on those bonds. Failing that, I would look at the interest rate profile potentially of bond instruments in neighboring countries, of other lending arrangements. So I'm looking for information that helps me think about, again, like Mike spoke about with the biological, gathering as much information as I can, and then ultimately doing a discounted cash flow analysis, so for fair value. But that's what IFRS 7 does, is it brings in all of these disclosures, and it brings in other disclosures. It brings in disclosures about credit, for example, or other risks that you might run. Now, people tend to look at credit and say, well, credit is a bank thing. But it's not. If you've got trade debtors, if you are selling stuff on credit to your customers, you have an exposure to credit, and you need to think about it. A more common one that people often lose sight of is if you lend money to your staff, you have staff loans, you have a credit exposure and you have to start thinking about it. Clearly materiality matters, but we'll get back to that later. Switch right to the top. So I've said IFRS 9, IFRS 7, IAS 32 is the standard that does a lot of the definitions. So when we're talking about the terms, it's telling me what those basic terms are and where I need to focus on and what I need to think about. So when we think about let's start with, when we think about the liability side of the balance sheet. So if I'm having to decide whether something is an asset or liability, okay, it's pretty easy. If it's a debit, it's an asset. If it's a liability, if it's a credit, it's a liability. If it's something that goes on my balance sheet, I've got a fairly clear depiction of which side of the balance sheet goes. And I actually should say, if it's an asset, it goes on, if it's a debit, it goes on the asset side. If it's a credit, it goes on the claims side of the balance sheet, the liability side of the balance sheet. But there is a tricky bit here, which is the definition between equity and liability. And you'll remember that when we spoke on Tuesday, we spoke specifically about the fact that one of the things the ISB is trying to solve for at the moment is for the less obvious things where we don't know for sure whether it's an asset, or whether it's a liability, or whether it's equity. Share capital, very easy. Bank borrowings, very easy, but in between there's some complicated areas. IAS 32 is the standard that the ISB is looking at revising, because it's the one that does this distinction between liability and equity. And it has a very interesting, and you'll see in a few minutes, IAS 32 defines what the words financial asset, or what the word financial instrument means, what a financial asset is, and what a financial liability is. And it uses a definition that's quite difficult or quite circular on the face of it. It says that a financial asset is a contract, so it has to have a contractual basis, that gives rise to an asset in one company and a liability in the other company. In other words, it's not like a chair. A chair is a chair. I own the chair, that's an asset. Nobody else can own the other side of the chair, the liability for the chair. The chair is the chair. A financial instrument is something where there is one person who has the asset and another person who has the other side, either equity or a liability instrument. And that's the definition of a financial instrument. It's a very easy one from that perspective. And then what you've got is you've got a bunch of, so now we've defined this big thing called financial instrument. We apply this big rule called a financial instrument to everything. And then what happens is IFRS 9 comes along and says this applies to all financial instruments unless there is another standard that is relevant to them. And just because we've been talking about insurance, let me take an example. An insurance contract is a contract. The insurance contract creates an asset on the part of one person, the right to claim. It creates a liability on the part of the other person, the obligation of the insurer to pay the claim. So that's a financial instrument. But then IFRS 17 says if it's an insurance contract, you go to 17, don't go to 9. So there's a clear split happening here. You first are in the financial instrument, but then you often root it out. A lease agreement is also a financial instrument. I have the obligation to pay my lease every month. Somebody out there has the right to receive that payment. It's contractual, it's a financial instrument, but it's scoped into IFRS 16. So this is a big definition that then gets sort of pieces carved out of it from all over the place. The standard then gives a whole bunch of examples of what are financial instruments. So cash, equity in another entity, right to receive an cash or another asset, right to exchange instruments, and then it deals with some of the complexities around equity. So we've got KCC, and I remember to fix the English version, but not the Macedonian version. So I fixed the English one, but forgot the Macedonian one. But anyway, so the important point here, what we said about KCC, buys and sells in cash and credit, has forward purchases of sales, permission to hold US dollars, excess cash and gold coins. And it lends money to suppliers to secure and expand what it does. So looking at those assets there, and can we do a quick questionnaire? So this is 1 to 7. So the answer is just yes here. But what I'm going to ask is I'm actually going to ask the people online to say yes for 1, 2, 3, 4, 5, 6, 7, or no for 1, 2, 3, 4, 5, 6, 7. For you in the room, I'm asking the same question. And just to make it easier within the room, which of this list do you think is not a financial asset? Okay, so which of these ones is not a financial asset on the list that we've got up here? Okay, so 6 is not. Okay, there we go. Let's just see what's coming through on this side too when we're done. And now I'm going to ask you to translate for me because I don't remember the slide completely. So what is 3? So claims from customers, we're saying might not be. Thank you very much. Claims from customers, trade receivable, yes or no? So we said maybe not. Okay. 4, you said not. Inventories is not. So we're happy that's not a financial instrument. Any other ones here? Any other ideas? So 3, 4, 5, 6, pretty much the same list you've given in the room is what's coming up online too, I think. And it always fascinates me how similar we are getting in terms of the views. So, okay, if you can put the English up, but let the questionnaire carry on for a few seconds, but let's put the English up. So currency, okay, we are saying in the room is an asset, is a financial asset. Now, currency is quite an awkward one because I have currency, so it's an asset in my hand. Remember the definition said it has to be a liability in somebody else's hand. So how is currency that I have in my safe a financial asset? Okay, it's interesting, and you'll see in a few minutes why it creates this sort of oddity. It's defined explicitly as a financial asset. And it does so because most currency has written on it that if you take that currency to the central bank, they have to give you something in return. Now, once upon a time, they had to give you gold. Now, typically what they'll do is they'll give you another note that looks exactly the same as the one you just gave them. But the truth is they've got to give you something. So that is the counterparty when we think about currency. Okay, so that's why it's a financial asset. Okay, so relatively few people responding. It seems like it's kind of settled down there. Maybe we let it run for a few minutes and then I'll keep talking. Thank you. So that's currency. US dollar bank balances. A bank balance is now a different one. It's not cash. What a bank balance is, it's my asset. It's the bank's liability. They owe me that money. Trade receivable. And this may be a translation issue, so I'll just confirm exactly. So trade receivable, the right to receive money from the debtor, from the person that bought something from you. Okay? In their hands, it's a liability because they owe you the money. In your hands, it's an asset because you're going to receive the money. That is a financial asset. Coffee beans, as we said, we can cancel coffee beans out. That's inventory. Government treasury bills. It's a contract. The contract says, I have bought this contract. I have the right to receive payment from the government. The government has the obligation to make a payment to me. So that's a financial asset. Gold coins is not. And it's not for the same reason we struggled with the cash. Okay. Gold coins is like a chair. There's nobody on the other side. There's nobody who has a liability for the chair. There's nobody who has a liability for gold coins. So gold coins is not a financial asset because there's not this corresponding. One of the things that you might have heard from Mike over the course of the last is, and we did have a question from somebody from the central bank yesterday, is that actually the problem with gold coins is it doesn't fall naturally anywhere. You can't use it as furniture and fittings. You can't sit on it. You can't live in it. It's not a financial asset, not a biological asset. It ends up actually being accounted for under the conceptual framework because gold coins just doesn't fit anywhere. And hence you need the conceptual framework for that. And then the last one, staff loans, definitely a financial asset. I have the right to receive money from my staff member under a contractual obligation. They've got the obligation to pay it to me. It's always good when the green comes up to make sure that I did answer the questions the way I set out in the green. Well, yes, just show me the other one quickly. Let's see. Okay, so it's quite mixed in terms of outcomes, and to be fair, so here's an interesting question that I haven't actually seen before, which I like. So currency is a liability, that's absolutely right. So people are keeping track here. Currency is fiat money, which I think is also correct. Is currency is just a representative piece of paper of what's owed between people. And the currency is a liability for the central bank, as we said. Is a current account in gold a financial asset? And I think the answer probably is, well, it's difficult. Let me answer it this way. It depends what the obligation on the other side is to deliver. But I think typically I would say, yes, it is. A current account is an arrangement between two parties. I have the right to demand my gold out of the current account. The company on the other side, or the bank, or whoever's holding the current account, has the liability or the obligation to give me my gold that is in the current account. I think that does potentially create a financial asset and a financial liability. All right. Okay, so I think we can move on then. Thank you. And thanks for the questions online. And that's great actually to see them coming through. Okay, other side of the balance sheet, what are the obligations? Again, lots of examples. Any obligation, whoopsie daisy. Oh, okay. Okay, perfect. Any obligation to deliver something, deliver cash, deliver another financial instrument, all of these things would be considered a liability. Likewise, on a derivative, if I have to deliver anything other than my own equity, that's typically a liability. I'm not going to dive into the details here because this becomes very complicated like we spoke about on Monday. So when you're thinking about the circumstances in which an equity instrument is either a liability or equity, the rules become very, very complicated there. And these tend to be quite esoteric type of contracts. At some point we can drill down, and there's quite a few examples in the pack that you'll get that just illustrate some of that thinking so that you can get an idea of when you think about something as equity. So again, looking at the same question, and I won't actually, in fact, you've got the questionnaire set up, so let's ask the questions again. What I'd say for each of these is people should say yes, or they should tick the box for 1, for 2, for 3, if they think the answer is yes. So if you think the answer is yes, please answer yeah, please answer. If you think it's no, don't tick the box for the number. I think just one, you can take multiple. Yes, absolutely, you can take multiple. Thank you. All right. So again, the same type of question. We're trying to think through the process here, and hopefully it's easier second time around. So which of these ones do you think are financial liabilities as we have defined financial liabilities? And again, I might ask you to have the chat amongst yourselves, and then Again, probably easier to answer on the negative. So which of these do you think are not financial liabilities? And then perhaps if you could. Yes, so 5 and 6 is no, as we're saying. Okay. And online, we're getting, it looks like yes, yes, no, yes, no, no. Oh, no, it's changed. Bitcoin is an interesting one. And now let me think about it. I don't think Bitcoin is a financial liability or a financial asset, depending on which side it is. And I'd look to a little bit of advice from the room too. So let's think about the way a Bitcoin works. I get a representation of value. So I have a Bitcoin. This is my Bitcoin. Okay. What a representation of value. That's an asset in my hands. Is it a liability for anybody else? Does somebody have to deliver? I can sell it and earn money, but does somebody actually have to deliver something to me simply because of my possession of that? And I think the answer is no. So I do not think this is a financial instrument. And I think this is where the trick comes with Bitcoin. How do I think about a crypto asset? Because nobody's got the obligation on the other side. It is a fiat currency, which I think is correct as well, but this is a slightly different one. With the money in my pocket, I can go to the central bank and make a demand of something. It's a contract between me and a central bank. With a crypto, there isn't actually another party to this space. And so I think that's the indication there that I think it isn't, which makes it interesting. It makes it different, and that's why when we talk about cryptos, we can't solve cryptos with financial instruments. So we end up having to solve cryptos by thinking about them as intangible assets because there isn't another counterparty to the transaction. Okay, so I think we've got quite an even distribution there, which I'm not sure how to read that even distribution. So maybe let's pop back into the, if you could leave it for the moment, and then we can pop back into the English, I think. There you go. Okay. Bank overdraft, financial liability. You owe money to the bank. Trade payable, financial liability. You owe money to a creditor. Creditor is owed the money by you. The outstanding account to pay for gold coins purchased. Okay. A little bit like we answered earlier when we spoke about the current account with gold coins. I have an obligation to pay money to somebody. Somebody else has the right to receive the money. Fair value liability of forward sales. Little bit harder now because now I'm potentially moving out of delivery of money or another financial asset. The fair value liability of a forward sale is typically I have to deliver an aeroplane, I have to deliver coffee beans, I have to deliver something. So the answer to this one becomes a maybe. If I have to deliver cash, so I have to deliver what's called a contract for difference, I have to deliver cash, it's a financial liability. If I have to deliver something physical, coffee beans or an aeroplane, it is not, because there is not a financial instrument on the other side of it. There's an expectation of receiving something. Liability for severance pay? Absolutely. You've got the obligation to pay somebody the severance pay. They've got the right to receive it. There is a yes, but on this one. There is a standard called IS 19 that specifically deals with employee benefits. So it is a financial instrument, yes, but it's not in IFRS 9 or IS 32. Provision for litigation expenses. Okay, what do you think? It's not a liability, it's a provision. So it's not a financial instrument. Not a financial instrument because there's nobody out there. There's firstly, for a provision, there is not a contractual relationship. Was the first thing. So you fail the test of contract. And secondly, there's not somebody on the other side who can automatically say, this is how much I'm owed. Provisions are outside of the equation. You can turn off the poll now. Thank you. Let's just have a look. Okay, so it got to an even split, but I think, to be honest, these polls, these yes/no polls with lots of answers, can be quite hard online. So I think we can assume that that was a misunderstanding of the question rather than of the answer. Okay, equity is the residual stuff. It is what is left over after after I've taken account of all of my assets, minus all of my liabilities. Whatever is left over is the equity, the assets minus the liabilities. And then, as I say, we get into quite a lot of complexity in IAS 32. So what IAS 32 now starts trying to do is this divide between what is what is a liability and what is equity. And really the key principle, equity is something I cannot be forced to pay to someone else. That's the bit that's left over in the company. So I might want to pay dividends. I might have every intention to pay dividends, but I can't be forced to pay dividends. And so dividends are equity, not a liability. Legally, it becomes interesting because in South Africa, for example, if a listed company declares a dividend, that dividend becomes due and payable. They have now made a promise to their shareholders. And at that point, it goes from being equity to being a liability at that point in the process because they've now created an obligation. Private company, it never becomes an obligation. So you can promise as much as you like. It only actually becomes a liability at the second that you pay it out. So it's a liability and then it disappears. But it's very dependent on what your legal structure is and how the legal structure works. But typically, as I say, the big question is, can I be forced to do something, to give away value to somebody else under an unfavorable circumstance? If I can be forced to give somebody money, it's a liability. If I cannot be forced to give it away, it is equity. And for the insurers in the room, you'll know that there is one exception to all of IFRS in this particular space. Some insurers create products where they the insurers, have discretion. So what the insurer says is, I promise you, I will pay you 3% a year. Okay. But I also think I might pay you a little bit more. I might actually pay you 4% a year or 5% a year. Okay. What they've done is they've embedded that extra 1.5% into the promise they've made to the customer. The IFRS 17 standard says you actually treat that as though it were a liability, because you act as though it's a firm promise that you've made to the customer. Okay. Just a derivative instrument, which is the last instrument we talk about. A derivative instrument is a slightly different one in that what we say with a derivative instrument is it's an instrument with a very low value. It doesn't involve the exchange of cash, but it involves the promise of something much bigger. So if I lend you money, that's clearly a financial asset, financial liability. If I say to you, we will take a bet between the two of us, that if interest rates go up, you have to pay me something. If interest rates go down, I have to pay you. What have we done? We've got a very low value contract because it's actually just based on the movements in interest rates, but it has the ability to move in significant ways if interest rates move in a big way. That's essentially the definition of a derivative. All right. So all we've done now up to this stage is the introduction into IFRS 9. What is the basic things we're talking about? So now we now know what what a financial instrument is. We know what a financial asset, financial liability is. Now we get into IFRS 9, and IFRS 9 tells me how to measure a financial instrument, when to recognize a financial instrument, how to account for it and disclose how to account for it in my financial statements. Starting with financial assets, what IFRS 9 says is I must think about the cash flow characteristics of a financial instrument. So what are the characteristics of this particular instrument I'm talking about? And the first question it asks you to think about is this instrument only the payment of interest and the repayment of capital? So it's called the solely principal and interest test. And what this test is asking you to say is this a simple way? Is this a simple product with predictable cash flows? So I lend you 100. I charge you 10% interest, 1 year loan. We both know that you're going to pay, if you pay me back, you'll pay me my 100 back next year, plus you'll pay me an extra 10%, so you'll pay me 110. It's a very predictable cash flow profile. That is solely principal and interest. I buy shares in your company. I have no idea what the value of the shares will be in a year's time. The only way I can exit that company, the only way I can exit that investment is by selling the shares, because the shares aren't going to pay me out the capital. They're going to, and I don't know what dividends I'm going to earn. A very unpredictable set of cash flows. So this test is just about distinguishing between predictable and unpredictable cash flows. So I think that's largely what I've said. What you're thinking about when you are looking at predictable cash flows is, are the cash flows appropriate to the instrument? So I lent you the money for 1 year. We agreed 10%. But if we then said, but if the interest rate changes in the Macedonian market, then the rate I charge you will also change. So it starts at 10%, interest rates go up, this rate goes up. Interest rates go down, this rate goes down. That is a situation in which the concept of interest in our contract matches the economic concept of interest. But if I do something silly, I say, okay, I'm going to charge you 10%, but if the horses win on the weekend, you only have to pay 5%. And if the horses lose on the weekend, you have to pay 15%. You're still paying me interest, but it's not an economic concept of interest anymore. I've just managed to find a way to bet on horses through our loan. Okay. So this is where I'm thinking about when I think about predictable, this is what I'm trying to get to the bottom of. So if I have a look here, if a company, our KCC company, whose name I'm not allowed to say, if KCC invests in Macedonian treasury bills, Macedonian bonds, 1 year bonds, these are auctioned, actually that should be January 24, I guess, but they auctioned last year, 25 January. The auction price is issued at 91.473. Now, just a little bit of background here for those of you who are not familiar with it. These treasuries don't pay interest coupons, so I'm not going to earn any interest on it. So what happens when I buy it at a discount, which is what compensates me for the interest. So this is not going to be any interest at all. I'm paying 91.473 for every 100 I buy. Essentially, that is my compensation for time value of money. So it implies that there's an interest rate of 9.47. Now, this happens at auction, so it's a proper market-determined rate. The full nominal amount paid out on the 24th of January 24, as we would have expected. What do you think? Does that meet SPPI? Okay. Goran, if we can just ask online again, let's keep them in on a Friday afternoon. So it's just an A/B question, yes or no. Okay, so what do you think? SPPI test? Okay, I'm seeing within the room, I'm starting to see a few yeses. SPPI, everybody. Does it worry you that there is only a repayment of capital and no repayment of interest? It's fixed. It's like a fixed interest rate. So we've got a lot of people saying, yes, it passes the PPI test online as well. And the answer is absolutely. So I know exactly, to the point we said earlier, I've got a very predictable cash flow. The predictable cash flow is sensible. So it is a reflection of the genuine time value of money. So the answer here would be a yes. And I'm glad to say everybody online is also yesing mostly. So bearing in mind for those people online who did say no, for anybody in the room who was thinking no, the reason why you might be thinking no is because there is no interest payment. But the point is it's a fixed payment and there's an implied interest. The interest that's in there is the sensible amount that you'd expect. Okay, let's jump back into the slides, I think. So let me just, are we back on the same page? Yes, we are. No, so we 1 out. There you go. Okay. There you go. Okay. So the next one, slightly different example now. Okay. So what we've got here is we've got the KCC company making a loan to its staff. So it's lending money to its staff members. It tries to incentivize staffs. The market interest rate is 10%, but KCC lends the money to its staff members at 5%. It wants to encourage staff members to hang around. It's trying to be good to staff members. So it gives them a lower cost loan. The loans are repayable in 60 monthly installments, so over 5 years. No penalty for early repayment. So if the staff member chooses to repay early, that's cool. And they deduct it straight from the staff member's salary. Goran, again, yes, no? What do you think? SPPI, solely interest and capital. Okay. We've got yeses around the room starting. And lots of yeses coming through. Does it bother anybody in this particular case that the interest rate is too low? Does it bother you? It does a little bit, but let's start with your test. Is it fixed? Do we know how much we're going to receive? Yes, we do. Do we know what the outcome is going to be? Yes, we do. But there is something odd about this one, isn't it? And we might get to it in a few minutes. If you have a situation in which you are paying for two things, or you're doing two things in a contract. Okay. So what are the two things I'm doing here? I'm lending money to my staff member, and I'm doing something nice for a staff member. Okay. Do you remember my principle from 2 days ago? Nothing is free. So why are you doing something nice for your staff member? You want to keep your staff member. You want to keep them loyal. You want to keep them on board. You want to keep them there. So actually in this contract, I've got two things happening. I've got a loan at market interest rates, and I've got a staff benefit that I'm paying at probably a market rate for that staff member to keep them. But so the answer here, yes is the correct one. And we're sort of happy with that. So happy to move on, even in spite of that 5% oddity. And thanks for the guys online again. So those came through. Won't you do me a favor and just go back, Goran? They looked like the question came through on SPPI there. I wasn't sure if it was a question or an answer. So I'm keeping you working hard on a Friday afternoon. So you're there. So is it, Lilette, difference is remuneration. So that's what we're saying. This is a staff benefit. Do loans with zero interest rates? If I just answer a couple of questions there, do loans with zero interest rate or below market interest rate meet SPPI? Yes, they do. But what IFRS 9 says to you is, because nothing is free, identify what that other thing is. So in a staff loan, it's a staff benefit, it's remuneration, as Lilette suggested. You have to look at it and consider where you think you actually are with that answer. Okay, on the same page. All right, so that's cash flow characteristics. So that's solely interest and solely principal and interest. Again, in the packs you're going to get, there's a lot more examples. And for those of you in the trainer position, this is one of those areas where examples really helps. People really get into the individual examples and sort of understand what's happening better with those. So second question that comes up, that's come up there, is in the example with the loans to staff, should we recognize in profit or loss? Absolutely. And I'll show you the journal entries in a second. So what has happened? I said I've done two things. I've given a loan for 5 years. And then in addition, I've given you something that is staff remuneration, that is a staff benefit. Then the only thing you have to do is you have to think about whether that benefit is immediate, boom, gone, finished, profit and loss, end of story. Or if you have conditions attached to the loan, whether the loan, in fact, whether that staff remuneration lasts over a longer period. So imagine I said, I'm going to lend you my staff member. I'm going to provide you with a loan to buy a house or buy a car, whatever it is. I'm going to provide you with that loan at 5%, even though market rate is 10%. So I'm giving you a benefit. The benefit is a staff benefit, but the condition says that if you leave before the end of 5 years, you have to pay me back some of that extra interest. You have to give me that extra interest In that case, what I'm essentially saying is this is not a benefit that I get that I'm paying for immediately. It's not, yes, I've got a happy staff member, I can move on. I'm actually saying I am handcuffing my staff member to encourage them to stay in my company over a period of time. So essentially, you've got to think about when do you get the benefit from a company perspective? And what we've done now is we've moved into IS 19. Oh, I seem to, thank you. Okay, so first test was SPPI test. Second test is called the business model test. The business model test is asking you what your business model is. In other words, how are you intending to take this financial asset and convert it into cash? Now, I've used the dreaded word that I should never use, which is intend. This is not an intention test. This is a what is your business model? How do you operate? What is the way in which you typically recognize or turn these items into cash? And the IFRS 9 gives you the business models that you must think about applying. So the first one, hold to collect. Okay. What does that mean? My business model is to collect the cash as it falls due over the life of a transaction. So go back to your staff loan. What is your business model on the staff loan? I've lent money to my staff member. I'm going to collect money from them every month until the 5 years are gone. I've got my money back. That is my business model because it's the intent there is the hold to collect intent. But I could also have a different business model. I could have a business model that's what we call a mixed business model. I'm going to hold it to collect, or I'm going to sell it. If I think about insurance companies, I think about banks, I think about pension funds, what these companies will typically do is they will very often have a mixed model. Why are they holding assets? They're holding assets because they have liabilities. They don't know when the liabilities are going to fall due. So they want to hold assets that whenever somebody comes along and claims their pension or claims lodges an insurance claim or wants to withdraw their deposits, they want under that business model to be able to sell the asset and use the money to pay the person's claim, pay the person's pension, pay the person's deposit. So that business model is a mixed one. I will hold the asset to collect unless I need money in the in-between. If I need money in between, I will sell when the opportunity comes along. In a business model like that, you typically also will say to your asset manager, to the person managing the assets, if you see a good opportunity to sell because the prices are high, sell. If you see a good opportunity to sell because your portfolio is out of balance, sell. It's an opportune business model. Hold to collect when you need to collect, but you're also welcome to sell when the opportunity comes. We want to be able to sell to fund our portfolio and ongoing issues as and when the opportunity comes up. I wanted to, and this is a response to a question I got on Wednesday, just to say that when you look at business models, a business model by definition has to be realistic. Okay. What do I mean by realistic? If I say my business model is to trade, so my business model is to buy and sell shares on an ongoing basis, but I live in a country where there are no shares for sale and no market to buy the shares from me. Okay. Can I really say my business model is to sell or to trade? So when you're looking at a business model, you're looking at, is the business model realistic? Is this the way I incentivize my staff? Is this how I determine whether or not they get paid bonuses? Is this how I determine their mandate? So if I employed a trader in and I said, your job is to buy and sell bonds, but there is no bond market, how do I pay that trader? How do I reward them for their activities? And chances are I can't, because they're going to say to me, but this is not fair. You want me to buy and sell, but there's nothing to buy and sell. So realism has to be a part of the business model that you're thinking about. But business model is established, and this test here, this business model test, is done at inception. You do this when the asset comes onto your balance sheet. and then it never changes. So if you decide your model is hold to collect, then it is hold to collect until that asset disappears. Next year's assets can be a different one, but I cannot change this year's assets. Once I've bought, they live on my balance sheet and that's it. The ISB built in something that said, under the following circumstances, you can change your business model. So it said there are circumstances in which you can change it. I had this discussion extensively about 6 months ago with the big audit firms, and nobody knew of a single company that had been able to meet the test. The test is very hard to achieve. So I think you just assume that if you've decided hold to collect, if you've decided trading, if you've decided hold to collect and sell, that's it. That is your business model. You don't change your business model through time. In fact, I'm going to go right. Well, let's just answer this one. So again, we got the same company, we got the same situation. I'm lending money to my staff. I'm not going to put this up on the questionnaire for the people online. We're just going to do it fairly quickly. In this company, essentially what happens is I collect the loans over the contractual period. So it's a hold to collect business model. But because I'm worried that my staff members might leave, because I think staff members will leave from time to time, I've got an agreement that says if a staff member leaves, they either have to repay the loan immediately, or by virtue of an arrangement I have with a bank, the loan will be transferred to the bank. So essentially, I'm selling the loan, aren't I? Essentially, what I'm saying to the bank is you take over the loan and you pay me the amount outstanding. I'm selling the loan. What is the business model here? Hold to collect and sell, or other. Okay. Hold to collect and sell, hold to collect and sell. Okay. This is just one of those nuances that's important, because I think your answer is a good one. The answer here makes sense to me. But what the standard says is that you look at what the primary business purpose is and don't worry about something that is incidental. In this case, what is my primary purpose? To provide a loan to my staff member and to recover that money from my staff member over time. It's incidental that sometimes a staff member is going to resign. And if a staff member resigns, I want an emergency plan for what happens. My emergency plan is I sell the loan to the bank, but it's the emergency plan. It's not the primary plan. My primary plan is I want to keep this and collect it all the way through. So you've got to be careful with incidental versus the main products. I'm going to go through all the examples quickly, get back here. So we said we test for cash flow characteristics. First thing, what are the characteristics of this? We talked about that. We test for the business model test. Why am I doing these tests? These tests determine how you measure these financial instruments on your balance sheet. Now, lots of people in the room thinking, well, this doesn't matter to me because I'm not a bank, I'm not an insurance company. Think back to that list we talked about at the beginning. Staff loans. You've got staff loans, this applies to you. If you've got an investment account with the bank, this applies to you. If you've got a 120-day deposit at the bank, this applies to you. So all of this is relevant to you. So how do we measure it? If it is hold to collect, the swear words for Michael, okay? So amortized cost. What is amortized cost? I recognize it on the day I start it. I add interest onto it every month or every quarter. Every time I repay it, I deduct it. Ultimately, this number will come all the way down to 0. That's the end of the account. If I recognize that there's something wrong, I don't think I'm going to collect the money, I think about whether I have a credit loss, an impairment. So that's amortized cost, nice and simple. And let me just see, I want to go through one quick example here, which is our loan to the staff member. Okay, well, I've given away the answer. Press 1 too quickly there. Okay, so what happens here? I've lent 100,000 to my staff member. The market rate is 10%. I've given the staff member the loan at 5%. So I've given the staff member the loan at a special rate. the loans are repayable in 60 equal months. What is the day one value of the loan? It can't be 100,000 because I've given away something else. I've given this other free thing. So if I discount the cash that I'm going to receive from the staff member, I discount that back to today, it doesn't give me 100,000, it gives me 88,000. And so the amount that I record today is the value of that loan. If I'd given the loan at the normal value, I would record this in my books at 88,000, not at 100,000. Because that creates a problem. Oh, let's first do this. So how do I do that calculation? Very, very simple in Excel. It's one of the nice, easy functions in Excel. Is I'm simply going to say, what am I expecting to receive? I'm going to receive a monthly payment of 1,887. What is the interest rate? 10%. What does that mean? The monthly interest rate is 0.833. Number of installments, and I do a net present value calculation of those items, and Excel gives me the number, 88,000. So Excel is a little magical tool with a lot of these things. This is the same calculation you could have done if you were trying to work out the fair value, because that's what we've done. We said, what am I getting? I'm getting a stream of future payments. What is the interest rate that is relevant to that? It is 10%. What is the present value of those payments at 10%? That's my fair value on the day that I issue the loan. And then we've already answered this question. That left me with this journal entry. I've got a financial asset, my loan to staff, of 88,800. I've got cash that went out of my bank of 100,000. My journal entry doesn't balance, so I've got to do something. I've got to balance the journal entry. The balancing amount is staff expense. I think that was something Lilette answered earlier on the... So there is my answer to get my journal entry to balance. Okay. And what I'm going to do is I'm going to stop here for our coffee break. 30-minute coffee break, if everybody can be back at 3:30. And then what we'll do is just finish off very quickly on this. And then I'm going to talk about impairment, how you actually do an impairment calculation as a normal company. Thanks, everybody. Thank you all. Welcome back and welcome to the people online. The last stage. You guys have been real survivors at this point, getting all the way through to this point. So thank you very much for staying with us. I'm going to spend literally another 5 minutes on classification. So how we classify. I just want to finish off essentially this slide and a little bit beyond that. And then we're going to go to impairment to talk about bad debt impairment and how you think about it. So where did we got to? We said we've got two tests. It's firstly a solely principal and interest. So what are the characteristics of the interest of the instrument? Then we move to the second test, which is a business model test. How are we managing these assets that we're talking about? What are the effects of the test? If we hold to collect, we measure at amortized cost. If we hold to collect and sell, we measure at fair value OCI. What does fair value OCI mean? It means on the balance sheet, I measure at fair value, but in the income statement, I measure at amortized cost. And the difference between fair value and amortized cost goes to profit and loss. Now, again, you'll be receiving the packs from this presentation afterwards. And what I've done in the presentation pack is I've gone into a lot of examples of how I would measure a bond at amortized cost, and then how I would measure exactly the same bond with exactly the same circumstances at OCI, at fair value OCI. And really the thing to keep in your mind is simply the way it works. Amortized cost, starting value, plus interest, minus repayments gets me to my closing value. Eventually it gets me to naught. Under a fair value OCI basis, my income statement will be exactly the same. So it will reflect only interest coming in and out over the time. But my OCI will reflect changes in the fair value of the instrument, go to OCI, and my balance sheet will have the fair value of that instrument. A lot of banks, a lot of insurance companies, a lot of pension companies find themselves in this, thank you, find themselves in the hold to collect and sell. Oh, you can put it back up. I'll have a look at it now. Find themselves in the hold to collect and sell. Okay, I'll get to this question in a second. So a lot of companies will say that they prefer this fair value OCI. The reason they prefer it is it reflects their business model, which is, as we illustrated earlier, sometimes to hold to collect, sometimes to sell. But what it does is it removes the volatility from their income statement. What is volatility in the income statement? It's when interest rates go up, you make a profit. When interest rates go down, you make a loss, or the other way around. And your income statement keeps going up and down. By applying OCI, you get to take that volatility out of the income statement. You park it in OCI, and your income statement continues to show interest income, interest expense through the process. Okay, Goran, can you put that question back up again? Because it's a good technical question. Okay. So the question here is a reference to a specific paragraph in IFRS 9. And this specific paragraph in IFRS 9 says, if I issue, now remember that staff loans example we talked about? If I issue a loan at a value and the fair value of that loan is different. So let's say I issue a loan at 100 and the fair value is 88. So this example we talked about with the staff loans, issued at 100,000, the fair value is 88,000. IFRS 9 says the difference between those two values, if the fair value of 88,000 is not demonstrated by an active market, okay, then what I should do is I should spread that profit or loss over the life of the loan. So I shouldn't take it immediately to the income statement. And this is it's a very good statement, particularly for banks or insurance companies or others who issue something into the markets, okay? And when they issue something into, where they, let's say, what's a good example? A good example is I issue a debt paper to a customer. So I say to a customer, here, I'm going to lend you money. You need to give me paper as evidence of this money. I then look at the paper I've got back from the customer. I gave them 100,000. I look at the paper and I say, actually, because I have access to a better market than my customer does, I could sell that piece of paper for 105,000. Okay. What IFRS would say to you is the 5,000 you cannot recognize immediately. You need to spread it over time unless there's an active market. So we think back to the staff loan. What did I say you must do with a staff loan? I said you must treat that loss as a staff benefit or that expense. This seems to say something different, doesn't it? The preceding paragraph, and I think it's the one immediately before this one. So this is B in brackets, the paragraph A says, unless the reason for the difference is the exchange of something else. I've given something for something else. So the first test I have to do is I have to evaluate whether there are two things happening, the loan and a staff benefit. If there's not, if I can't explain the difference, then I can't magically have a profit appear. And that's what paragraph B is trying to say. So very important paragraph and very good, very important to read the paragraph before as well. So thank you for that question. Okay, so this is the accounting. If it is a simple instrument, simple cash flows, and I'm holding it to collect amortized cost. If it's a simple instrument and I hold to collect and sell, fair value OCI. Then the standard says, if I am not hold to collect or hold to collect and sell, so this is now a negative test, then I have to account for a fair value. Now, if I'm not hold to collect and I'm not hold to collect and sell, then my business model is trading. I'm buying and selling the whole time. And if I'm buying and selling the whole time, IFRS 9 says I must treat that as fair value profit and loss. If you are not a bank and you're not an insurance company and you're not a pension company, almost certainly the answer to your question there is going to be one of the hold to collect or hold to collect and sell. It's going to be very unusual that you are trading in these instruments. But I'm not going to exempt it. There's definitely going to be circumstances where this might happen. So in that case, you're in fair value. The more important one is if you fail the cash flow test. What does fail the cash flow test mean? You have a complex instrument. Remember we were doing that instrument where we were betting on the horses in between? Okay, it's a complex instrument. We have to account for that instrument at fair value through profit or loss. Why? Why does the standard require this? Because a complex instrument like that is very, very hard to value at amortized cost. Amortized cost is nonsense. If I bought shares in Apple a year ago, okay, does the amortized cost of those shares tell me anything at all? It's nonsense. It's a nonsense number. If I bought government bonds in North Macedonia a year ago, the amortized cost is probably a very reasonable approximation of the value now, but shares not. So shares are a complicated instrument. I would account for those shares at fair value OCI. So that's where we get to at the end here on this. I wanted to raise two things quickly as an example before we move on to impairments. So the example that I got asked during the break is about a perpetual bond. And the question is, if I think about a perpetual bond, if I think about the concept of a perpetual bond, okay, it's never going to be repaid. Okay, a perpetual bond has no maturity value at all. Okay. Does that make it equity? And if it doesn't make it equity, how do I value it? Perpetual bond will typically require you to pay interest coupons over time. Okay. And it's a requirement to pay interest coupons. So a requirement, an obligation creates a liability. Present value that liability back to today, that gives you the value, the present value those cash flows back to today, that's the value of your liability. So just think about instruments like that. You can see it would still be a simple instrument because there's only one type of cash flow, the coupon each period. Okay, but I think about it in that particular way. That's the end of what I wanted to present to you on classification. So let me just check if anybody's got any questions on classification. All good? All happy? Nothing online? Okay, so now what I'm going to do is it's like one of those old movies where you go very, very fast because I need to jump ahead quite a few slides to where I want to be. So you can sort of watch this happening in the background. And then hopefully, by the time we get to where we want to be, which is here, we would be the same page on both. And because of the magic of Goran, we are on the same page in both languages. Thank you. So we've talked about how we value fair instruments, how we measure financial instruments. And what we said is we measure fair value if the instrument is a fair value, if the instrument is a complicated instrument or our business model is trading. So let's stop and think about that for a second. So if I'm measuring something at fair value, do you think I need to have an impairment adjustment, a credit loss adjustment? What do you think? Yes? Anybody else? Yes? Yes. So quite a few people saying, if I'm measuring something at fair value, I have to have credit loss adjustment. Now let's think about it. If I want to sell you a financial instrument, the lady at the back, I'm going to sell you a financial instrument. And this financial instrument is a loan from a company operating somewhere in the country, and the company is rubbish. We both know the company is not going to repay the loan. Okay. Would we take that into account in measuring fair value? Would you pay me the full value for the loan, even though the company's rubbish? Or would you say to me you want a discount because the company is not going to pay? Okay. So importantly, if you are talking about fair value, impairment is irrelevant. Impairment is irrelevant for fair value because it is already included in the fair value. If there are credit losses, if the management team is bad, if there's anything like that, is already captured in the fair value of the loan, is already captured in the fair value of the instrument. So when we talk about impairment, and we'll get to that question in a second, when we talk about, oh, okay, that was just a thank you very much for the answer. Okay, and some happy smiley faces. If we are thinking about impairment, impairment is only relevant to an amortized cost instrument. And it's only relevant to an amortized cost instrument because this simple value that we talked about, original principal plus interest minus repayments, does not take into account bad news for the company. It doesn't take into account good news either. It doesn't take into account any news. But when I'm thinking about a fair value instrument, the fair value always takes this into account. So if Michael was here, he'd be saying to you now, you see, this is why you need fair value. Yes.
Don't have a market value of listed share.
Yes. So, and this is a really good question. So what happens now if I don't have a market value for the instrument? So what do? So then what you're ending up doing is you're saying, I have to approximate fair value. The way that I would approximate fair value is exactly as we've spoken about here with fair value of other things. What are my expected cash flows? Discounted back to today. Now let's think, if I have a loan that is 100 and it's supposed to pay interest every period of 10, but I think they're not going to pay the interest anymore because they can't, and I think they're only going to pay me 70 in 4 years' time. My fair value is going to be 4 years' time 70, no interest in between, discounted back to today is how I calculate fair value, and my fair value might be 50. Now my fair value has captured my expectation of expected credit losses, and there's no need to go through what we're going to go through here. Okay, any other questions? All good? All good? Okay. So when we're thinking about impairment, we are only thinking about assets carried at amortized cost. Whoops. Goran, I seem to have gone out of sync. Oh, there you go. No, there you go. Perfect. Thank you. The assumption that IFRS says, and this is an interesting one, it's an economic assumption you need to get your head around, is IFRS assumes that there is no such thing as bad credit. Okay. There is simply badly priced credit. So what I mean by that, if I lend to I'm not sure the US government's a good example anymore, but if I lend to the US government in US dollars, I'm assuming there is a very, very high probability they will repay their loans. Okay. So I charge them a very small interest rate that reflects the risk. Okay. If I'm lending to myself, or if I'm lending to Daryl Scott, there's a much higher probability of loss. How do I compensate? I price for it. So I charge Daryl Scott more interest than I would otherwise. If I'm lending to somebody who's really, what we in South Africa, microfinance losses tend to be about 35%. So I'm lending to somebody who is a very high credit risk. What will I do? I will simply increase the interest rate on that very high risk, and I'll charge them 40% so that I've priced for the risk I'm taking. So applying IFRS, the economic concept here is the microfinance and the US government are exactly the same as long as I have got the pricing I expected to get. So almost zero for the US government, 40% for the microfinance. I've priced correctly for the risk, therefore I have no risk. My risk is the same for both because the pricing equalizes the risk on them. So that's the principle in which we start with. That means that you only have a credit loss, okay, when the risk declines. So if the US government now becomes riskier, but I'm still getting 1%, now I've got a problem. My pricing is wrong and I should recognize a loss. If the microfinance is 30% loss and it improves to 25%, it's still much worse than the government, than the US government, but I'm over recovering interest. So the pricing is good, so I don't have to worry about it. On the US government, if it went from 1% to 2%, I have to worry about it because I'm now not getting compensation. That's the theory that we think about. Deterioration is what we're trying to measure. A reminder, when we talk about the scope of IFRS, when we talk about the scope of IFRS impairment, we are talking about all of your financial assets at fair value or OCI, at amortized cost or OCI. This means supplier loans, it means staff loans, it means bank balances, it means trade receivables, so your debtors, it means lease assets. So all of these are assets that you probably have in your companies. All of these, if they measured at amortized cost or fair value OCI, you will have to do this calculation as part of your overall exercise. And as I said, what we're trying to capture is not absolute risk, but mispriced risk. Mispriced risk, I'm trying to capture deterioration. So this is referred to as the deterioration model. And again, important point here, the two blocks on the bottom of this slide, the left and the right-hand side, the ones on the left are subject to the full deterioration model. So if you have supplier loans, you have staff loans, you have bank balances, those will all be subject to the full deterioration model. The ones on the right, trade receivables and lease payments or lease receivables, you're allowed to use the simplified model. But if you've got staff loans, you're using this full model over here. Is impairment relevant for an investment in associate? Yes, it is. But it's a different impairment test. It's not this impairment test because the investment in an associate is an equity investment. You've got both shares and you've got potentially loans. And so you have to think about them together. But I'd like to answer this question and say one further thing, because the question that's not on there that is important. If you have a loan to a fellow subsidiary, it is subject to the full deterioration test. It's a loan. Okay, and so you have to think about it. Obviously, on consolidation, it cancels out and then it's gone and you don't have to worry about it. But in your standalone financial statements, you have to show it. And let's say you're a North Macedonian company and you lend to your fellow subsidiary that is in Montenegro, and you prepare financial statements here and they prepare financial statements. Those loans will be on both financial balance sheets, and they will have to reflect the impairment test. Oh. Sorry, does somebody have a question there? No? All right. So then moving on from here to the deterioration model. Because this is a deterioration model, what it is trying to capture is progression over time. So progression through the credit cycle. So what happens on the day that we start, stage one, we issue a loan, we grant a loan to somebody, it comes into our books immediately. At that point in time, I would normally expect to have what I would call a performing loan. So I've given the loan to my staff member. I'm comfortable right now. The only reason I gave it to them is because I thought they would repay. I'm expecting that they will perform the way I demand of them to perform. What the standard says is I must look ahead 12 months and I must estimate whether I expect that this loan will default in the next 12 months. Okay, I think there you go. I must estimate if I think this loan will default. So what is the probability of default? The probability of the staff member not being able to pay. And then I must multiply that by something called the loss given default. So if I've lent money to my staff member and the staff member is going to use the money to buy a house, and I know the value of the house, and the house is my collateral, I might argue that the amount I expect to lose is very, very small. So even if they can't pay, I'll take the house. And as soon as I take the house, I can sell the house and pay off the loan. So my loss given default is very small. On the other hand, if they've used the money to pay off their credit card debt, then that money's gone. Okay, so now if they can't pay, my loss given default might be 100%. So I'm doing this calculation. What is the probability they will fail in 12 months? Multiplied by how much I will lose if they fail to pay gives me the loss amount. And on the interest revenue side, I continue to recognize the interest that is in the contract, whatever that number is. So it is the balance of the loan times the effective interest rate. No issue at all with the first one. Let's go straight into into the model again. All right, so that's what happens at the first instance. Then my next step is, what happens if the loan becomes underperforming? Okay, so the first one was it's performing exactly as I expected. The second scenario is the loan has now stopped performing the way I expected. Something has gone wrong. So maybe if it's a staff member, I've given the staff member a disciplinary hearing. I'm thinking about whether or not I want to fire the staff member. I know if I fire the staff member, they're not going to be able to pay the loan. If this is a loan to a supplier, the supplier has been supplying fine, there's been no problem. Suddenly the supplier is experiencing problems and they can't supply. We haven't missed a payment yet, but the loan is not as good as I expected it would be when I granted it. So I bought government bonds in the US 6 months ago. Now we've got a new president in the US. The new president in the US is saying that maybe defaulting on loans is a good idea. He has said that. Do I think that increases my risk? If it increases my risk, I'm going to say it's moved into underperforming. Okay. Because I'm not sure anymore. I'm not as sure as I was. If I was going to give them a loan now, I would charge them a higher interest rate. That's what I'm trying to capture. So if I'm in the underperforming in stage 2, I now move to something called lifetime expected losses. Lifetime is, I say, how long do I have this loan for? What is the chance of probability of default any time over the remaining period? Now remember, this might mean, if it's a credit card, I'm looking at 1 month because a credit card's lifetime is 1 month. So if I've got credit card debt, I might say 1 month. But if I've lent my staff member money to buy a house, and I've said they can pay it off over 20 years, now what I've got to say is, what is the probability of default over 20 years? I'm looking far into the future to measure what I think I might lose over a long period of time. And again, I'm going to multiply that by what is the loss given default? How much will I lose if the default actually happens? And again, I'm going to calculate interest in my income statement, applying the methodology that we've got, which is the balance outstanding times the effective interest rate. So my interest income recognition stays exactly the same, but what would typically happen in this circumstance is the amount that I'm going to record as my bad debt has gone up. How do I record that bad debt? Okay, and there are examples in the pack, but I'm not going to go through them now. What I'm going to say is the way to record this bad debt is to say, the same way as we spoke earlier when I said I'm expecting a payment in 5 years' time. Okay, I'm supposed to get 100 in 5 years' time, and I'm supposed to get 10 of interest every year. But now I think I'm going to get nothing for the next 5 years. And in 5 years' time, I'm only going to receive 70. I say, what is the present value of the 70 in 5 years' time? Present value of 70 in 5 years' time comes back to today, and it's 50. What is my value on my balance sheet? The value on my balance sheet is 100. The difference between 100 and 50 is my expected credit loss. It's pretty much economics. If you are dealing with 5 loans to customers and 1 loan to a subsidiary, it's pretty easy stuff, and Excel is your friend. Okay. If you are a bank or an insurance company or a pension company, you've got lots of these things. Excel is not always your friend. It becomes very complicated, and you have to go through the process. But for the companies that have got less of these, it's a relatively easy calculation to do, a relatively easy calculation to think through. Oy. Let's carry on. Okay. Now I move from stage 2, underperforming, to stage 3, non-performing. What does non-performing mean in stage 3? It typically means, so when I was in stage 2, I was just worried because Donald Trump had been elected president, and I said, oh, does that mean I've got more risk? Okay. When I get to stage 3, Donald Trump has said, we are not going to pay our debts anymore. So now what I have is tangible evidence that we've got non-performing. Okay. I've got real evidence on the ground that it's non-performing. Okay. Now what happens is now we've moved into drama, because what happens with a company, if you were in performing, you loved your customers. You were very happy. This is fine. They can lend money. You loved your suppliers, whoever it is. You said, I'll give credit. I'll lend money to my staff because they're doing what I hoped they would do. When it got to stage 2, underperforming, I start saying, oh, maybe I need to fix. Maybe I need to talk to my staff members. Maybe we need to see what plan B is, etc. When I get to stage 3, I just want out. I don't want to have anything to do with this anymore. I want to now move my investments. I want to stop lending to staff. I want to get the staff member to pay me back. Okay. So stage 3 is the stage at which you're starting to take real action to exit the process. So the standard says again, lifetime expected loss. So how much do you expect to lose? And typically in stage 3, when I talk about the probability of default, typically in stage 3, default has already happened. So that number is 100%. Probability of default is 100. Okay. When I look at loss given default, it's the same equation. I've now got default. So what I'm looking at is how much value does this person or this company or this individual owe me right now? That is my loss. That is the total balance. I multiply that total balance by how much I actually expect to get back. And then I'm doing that same maths, present value of the future cash flow coming back to today. I haven't got on these slides, but there's one additional metrics that you need to think about. So we've talked about probability of default. We've talked about loss given default. The last one is exposure at default. Usually what happens when I'm looking at a loan, I lend you 100. Okay. I think the worst thing that can happen is I can lose 100. I can't lose more than 100. I've lent you 100. I can only lose 100. Okay. But for some types of instruments, it might be worse than that. And if I think about a simple example, you have a customer. The customer is buying your product from you. Okay. You say the customer comes to you and says, look, in the winter, I buy more. In the summer, I buy less. So can I have a credit line that allows me to go to 1,000 in the winter, and then I'll pay it off as we go into summer? And I'll say, cool, I'll give you a guaranteed credit line. You, my customer. Today, my balance to the customer is only 30. Okay. What do you think the balance to that customer will be when everything starts to go wrong for the customer? Normal behavior says the customer is going to use as much of that credit line as possible. So what they will do is they will take it right up to 1,000. So even though I only am owed 20 now, if I have promised the customer that they can draw up to a maximum of 1,000, then when I start thinking about these scenarios, I'm probably saying that the exposure at default will be much higher. It will be 1,000. And then that's what I'll build into this. The probability of default times the exposure at default, the amount, times the loss given default. This is less relevant for most of you who are not in banks, but for banks, there's a massive amount of effort that goes into what's called behavioral actions. And so, for example, a credit card instrument is almost always maxed out when somebody gets into trouble. What do? The first place you go to, you draw as much out of your credit card as you can go. Next place you go to, you draw as much from your overdraft as you can. So even if those balances are 0 and 0, when I'm doing this from a banker perspective, I say how much is the maximum amount they can take, because that's probably going to be the balance when they go bad. So you have to think about exposure at default as well. Okay, so we've got non-performing. We're thinking lifetime expected loss, probability times loss given default. And now we stop accounting for interest the normal way. Okay, instead what we're going to do is we are simply going to say, what is my discount rate on that amount I expect to recover? So again, let's think about that contract we've been talking about. I've lent 100. I'm supposed to get 10 of interest every year. At the end of 5 years, I'm expected to get 100. The 100 back plus the interest at each period. Now I'm looking at this and saying, this guy is non-performing. I don't expect to get 10 and 10 and 10 and 10 and 10 and 100. Instead, I expect to get 0, 0, 0, 0, 0 and 70. Discount the 70 back to today and I get 50. The only interest I will recognize now is 50 times the interest rate I've used, which will go to 55 times the interest rate, 60 times 60. When I get to the end of 5 years, that value will be 70. I'm recognizing the net interest. I am not recognizing the contractual interest of 10 and 10 and 10. And that is the deterioration model on one slide. This is everything you need to know about the deterioration model. The key thing about this is there's a lot of judgment involved here. And you can see how there's a lot of judgment involved here. You're going to have to make assessments about the people that you are lending money to. You're going to make assessments about your staff members. You're going to decide whether they are good, going bad, going worse. All of these are judgment decisions you need to make. And you can see when we went to the coffee break, we were on slide 90. We've now seen 3 slides and we're on slide 133. So you can tell in between there are a lot of hidden slides that tell you about the judgments you need to do, how you do those judgments, how you think about those judgments. If you are in the train-the-trainer space, this is where you make your money. Teaching these judgments is the hardest part and sometimes the most fun part. And you teach them, in my experience, with as many examples as you can come up with. This stuff you learn best with lots and lots of detailed examples. And I'm not going to go into the detailed examples now because I don't want to spend too much time this afternoon. Okay, so as I said, that is the deterioration model. But I hinted to you earlier that there is a simplified model, a simpler way of doing it. The simpler way of doing it is very much like the old way we did it under IAS 39. I'm using historical loss rates. So I look at, I've got 1,000 outstanding. I say, how much did I lose on the 1,000 in the last 5 years? My average was 5%. I take the 1,000, I multiply by 5%. That gives me my bad debt number. So when do I get to use it? When do I get to use the simplified example? If the debtor comes from a transaction that was done, that fell under IFRS 15, so a revenue transaction, then I must use this simplified method. Okay. So we talked on day one, I think, about selling Teslas and offering credit, selling Teslas on credit. If you are operating, if you are Tesla, you have to apply the simplified approach to your debtors book. Because how did the transaction originate? I sold a Tesla on credit. Okay. So simple way to think about it, and you get to apply the simplification, and it's mandatory. You apply it whether you like it or not. Oh, no, actually, I thought I was oversimplifying it. Unless there is a significant financing component. So what is a significant financing? Remember, we discussed this actually when we talked about IFRS 15. We said that if you are selling it and it's repaid within a minimum of 12 months, you can assume there is no financing component. If you sell something and you sell it at the same price, whether you're selling it on credit or for cash, there's no significant financing component. So as long as there's no significant financing component, you assume that you have to use the simplified approach. Now, if I think about Tesla, the example with Tesla, almost certainly when I think about the example with Tesla, they are charging more if you buy it on credit than you buy it for cash. Otherwise, everybody would buy on credit, let's face it. Why would you buy it why would you buy it for cash if you can get credit for the same cost as cash? So we assume that there's significant financing. Therefore, this mandatory exclusion doesn't work for Tesla. But if we think about the examples we were talking about with KCC, we said KCC borrows money lends money to their customers for 6 months or 3 months or 30 days or whatever it is. There you can assume there is not a significant financing element, and then you have to apply the simplified approach. And there's the suppliers, so there is an example here. So I'm going through fairly quickly because I don't want to spend too much time on the examples, but the examples are there. So that was mandatory. There is also an optional choice where you can decide if you want to use the simplified approach or you want to use the deterioration approach. So the first one is for trade receivables now for the Tesla example, but in this case now we say there is a significant financing. So you can see Tesla still gets to use the simplified approach, but they're not forced to use it. And I talked the other day about Volkswagen and said Volkswagen essentially runs a mini bank. They treat it as a segment. It's part of their operations. They do it. Volkswagen, I think, has already decided, if I remember from their numbers, they use the deterioration model. They think that's more representative than the simplified model, and they can choose to do that because it is significant financing, but they think it represents their maths better. If you have lease receivables from transactions within IFRS 16, so Mike talked about IFRS 16 yesterday. So what is happening? You are leasing something out, you're leasing a building out to somebody, you've agreed with them that they will pay you lease payments for the next 5 years. That creates a lease receivable, an amount that you have to collect for the next 5 years. You would treat that collection for the next 5 years as an asset, and you can decide whether you want to use the simplified method or the more complex method. And I think by the sounds of things, Mike spent quite a lot of time talking about the different choices in the standards. So essentially what happens is the standard says here, you can choose, make a separate accounting policy for each type of asset. But once you've made it for that asset, you must apply it to everything. So if you decide that for your leases, you're going to treat it as the simplified method, but for your motor vehicle finance, you're going to treat it as the deterioration method. You must apply it to all motor vehicles the same and to all leases the same. And again, I'm going to jump through the examples. All right, and then the answer here in terms of how you do the calculation is you're doing the calculation as typically what's described as a provision matrix. A provision matrix says, I just look at my historical losses. I split my historical losses based on an aging thing. So let's say if it's 0 to 30 days, I apply 1%. If it's 30 to 60 days, I apply 5%. If it's 60 to 180 days, I apply 10%. I'm just using my historical indication of how much I have lost in the past. Apply that percentage to the outstanding balance. It is pretty much an Excel spreadsheet type of thing. And the only thing I have to take account of is there a reason why my historical average might be wrong? So midway through 2020, when we're in the middle of COVID, you might have had to argue that my historical numbers don't make sense anymore, especially if you were selling coffee beans and the coffee shops are all closed. You might say, well, actually, I've got a bigger problem now than I had then. But typically what you do is you just apply that matrix and the matrix just flows through to everything you're doing. Okay, so those are the two big chunks of IFRS 9 that you really need to know and understand from the perspective of what you're doing, what you're teaching. Classification and measurement. How do I classify assets? How do I classify liabilities? Measurement, fair value, amortized cost, fair value OCI. Then when I get to impairment, I think about the amortized cost model, and I say I have to apply an impairment model to the amortized costs assets. I also have to, because remember we said fair value OCI, fair value on the balance sheet, amortized cost on the income statement. So I have to do the calculation of impairment for fair value OCI to get the number that goes on the income statement. And that's IFRS 9. It's easy. All right. As I said, we are now, I think we were up to slide 176. So there are a lot of slides here. I just want to pick up on some of the questions online, and then we'll check if there are any questions in the room. So there, somebody actually answered. I said the investment in the associate is subject to a different test. And you can see what we said. The impairment test for associate is IS 36. So somebody online asked the question. Somebody else online answered the question. Then we said, could loans return from stage 2 to stage 1? Absolutely. So I'm worried about using too much of a Donald Trump example, but let's assume now we say Donald Trump has been elected. We're now concerned about whether the US will make payments. So we move it into stage 2. 2 days after he gets elected, he says, look, this was something he was talking about. It was campaign rhetoric. Of course, he's not going to do it. Of course, they're going to repay their debts. You will move it back to stage 1, subject to the test for moving back to stage 1 will typically be higher than the test to move to stage 2. So I'll give you a simple example here. Normally, the reason why you move from stage 1 to stage 2 is somebody says, I'm in trouble. I just lost my job. I don't know if I can keep paying. Okay. So you move them to stage 2 because you want to keep an eye on them. 3 months later, they tell you, I've got a job. I'm fine. I'm back in the running. I can carry on paying my loans. You don't ever feel quite as good about that person. There's always a little bit of a, I thought they would never lose their job, and then they lost their job, and now I'm not so sure anymore. Okay. So I thought that the US would never elect somebody who wouldn't pay their debts. Then they did. Now he says he will pay their debts, but how sure am I? So what you've got is you've got a little bit of a higher test. And typically this is something where normally what banks will do is they'll give 6 months, they'll see what happens, they'll see how the new job works out, they'll see whether or not everything's okay, and then they will rehabilitate. But absolutely you can rehabilitate somebody. And for that matter, you can rehabilitate them from stage 1, you can rehabilitate them from stage 2, you can even rehabilitate them from stage 3. So even if they have defaulted, and then they come back and they say, all right, I want to get back. If they prove themselves over time, you would bring them all the way back to stage 1. You'd recognize them in that space. Okay, so the next one. And I think I'm just trying to remember the acronym at this moment, but what it is that you can, from time to time, a company will buy an asset that is already not performing. And I've just forgotten what the acronym for it is, what the description for it is. But what am I doing? I'm buying a bad debt. Now, the one way that can happen is I can actually take over a loan portfolio. Okay. And when I take over the loan portfolio, it's got a bunch of bad debts in it, or it's got a bunch of stage 3 or stage 2 debts in it. What will I do in that case? If I'm sensible from an economic perspective, I will pay less for that book because it's underperforming. So it's a purchased originated credit investment. There you go. So POCI. Okay. So what have I done? I bought something. The face value is 100. I'm paying 90 because it's already not performing the way I expect it to. I put it into the category because it's now undervalued. Now what happens is that particular loan comes along and says, hey guys, I've just inherited money from my grandmother and I've got all the money and I can repay all of my loans and I'm happy and I'll go back to normal. There's no point in treating that person in that category. So you would rehabilitate that loan. Okay. And that's perfectly acceptable with there you go. Purchased or created initially impaired assets. So you can rehabilitate these loans as well over time. Any questions from the room? You've been out-questioned by the people online. Any last questions? And bearing in mind, this is pretty much the end of it, although there's already a chance that Mike and I might come back and talk on a different topic sometime. So hopefully we get to see you and meet you again. But any last questions anybody's got on the topics? Going, gone. Did you want to say something before I? I've got to go check with the boss. Give me a second. So thanks everybody online. We are going to be finishing off. I just wanted to then talk to you about what is next, what goes out. So we will be distributing the full slide decks of everything that we've dealt with. As you can see, we're now on slide 176 of this pack. We certainly haven't looked at 176 slides, so there's a lot more content in the packs. I think also importantly, the packs that we distribute will include both questions and answers. So wherever we've got examples, we'll put the answers are in the examples, and you can obviously use that. Typically what happens is if you have got any questions that come out of the process, those can be circled back through the Institute. And if there's anything specifically that they can't solve, they'll tend to pop through to us and we'll write responses on those questions. So I think with that, and I'm just going to check at the back if we are ready. We good? We good? Okay. Then I'm going to happily hand over this thing. I keep forgetting when I've got it on and when I got it off, so I'm very glad to just get it off and hand it over and say thank you very much.
Thank you very much, Darren. So I see that after 5 days, 4 days, but actually 5, let's say, after a heavy week, you are still committed, and I see all of your faces like well awake even at this time of the afternoon in a Friday. So congratulations to all of you for this, because I know that these type of trainings are needed, but are heavy technically. So it's nice to see such an engaged audience. On behalf of the World Bank, we are very happy to have had this first series of trainings within our eAssure program. We are happy that as one of our main goals to strengthen education capacity, accounting education capacity in the country, we think that the trainer of trainers is the perfect vehicle, and we thank you for being part of this initiative. We will continue, of course, supporting the country within the 4 years that we have down the road with the program, but it's very nice to have our first cohort, let's say, of trainers within the train of trainer sessions that come from eAssure. So from my side, again, a big thank to all of you, and I will leave you with Vesna for the final closing remarks. Thanks again, and you deserve all an applause. She will take this to the team, so we split it.
Здраво на сите. Најпрво фала ви што издржавте овие 4 дена. Фала и на мисијата на Светска банка за поддршката. Мислам дека одржувањето на оваа 4-дневна работилница уште еднаш ни покажа дека континуираната професионална едукација има големо влијание и можеме значително да го подигнеме квалитетот на сметководствените услуги, она што е главната цел на институтот. Овој настан беше одлична можност да се запознаеме со најновите стандарди за финансиско известување преку практични примери, нивна примена и истовремено да добиеме одговори на дилемите и предизвиците со кои се соочуваме во секојдневната работа. Верувам дека на дополнетото знаење кој го стекнавме на овој тренинг ќе бидат дел и од редовните обуки кои ќе се одржуваат за сметководителите и на тој начин ќе креираме ланец за пренесување на знаењето и практиките, а со главна цел унапредување на сметководството во професијата. Уште еднаш би сакала се заблагодарам на мисијата на Светска банка за одличната соработка. Ви благодарам на сите, имајте убав ден и убав викенд.